Welcome to Capital HQ, where exclusive access to the private market and curated deal flows await you. Dive into a world of possibilities, from innovative startups and scale-ups to lucrative IPOs and high-yield credit opportunities, all at your fingertips. Gain unparalleled investment insights from some of the leading minds in the industry. Stay ahead with our expert perspectives from around the globe. Connect and network with fellow investors of similar caliber. Join our exclusive in-person and online functions to share, learn, and grow together. And the best part? Joining Capital HQ is completely free for investors. Become part of our proprietary network of over 33,000 investors today. Discover, invest, and network with Capital HQ, your gateway to the future of investment.
Good afternoon, ladies and gentlemen, and welcome to the Capital HQ Online Investment Showcase. We are very excited to bring you today's event. So, the reason we started doing this is that we realize that often when we host our in-person events, many of you are either not in Sydney or unable to travel or may not just be able to come on that day to actually see the companies live and in person. So we actually built software inside Capital HQ to facilitate that journey. So every sort of 2 to 3 months, we look to host the Capital HQ Online Investment Showcase, where we can bring you some of the exciting companies that we have the opportunity to work with. Now, as I've mentioned in my previous sort of keynote speeches and talks, and I'll be giving you a talk later on today, really highlighting what my perspective is, and I suppose the context that I see what's happening in the markets and what I sort of think will take place over the next 12 to 24 months. Today is really about showcasing some exciting high growth and also high yield opportunities for you to have a look at. Now, the way this has been done is we've set it up in an easy way in which you can actually view the companies inside Capital HQ. I assume you're either watching this on YouTube or you're watching it inside Capital HQ. All you need to do to basically, if you like one of the presentations from the companies, simply request access to their deal room. And then from there, you'll be able to engage them directly. So they'll accept your request, and then they'll be able to have a conversation with you one-on-one. They have their information, their pitch deck, they have their sort of latest news, announcements, frequently asked questions, etc. It's all designed in a way to make it simplified and streamlined for you in accessing their information. So the other part about that's unique with today's event is that you get the opportunity to connect with other attendees as well. So if you go into inside the investor networking zone, you can see the other attendees for the event and you can actually network with them directly. Now, we're also recording this, so if you're watching this after the event, we do recommend you still go in, request access, and then also communicate. Because to me, what's so important about hosting these online sessions is you get an insight into some of the exciting opportunities that we come across every day. Now, one of the things I highlight about what's different between the sort of online event as opposed to in person is that you're effectively creating the opportunity to engage at a much deeper level during the actual session. So whilst they're talking, not only listen to their presentations, but also use that second screen to go and do a deep dive into the company's opportunity or network directly with the CEO behind the company. So under the networking zone, you're able to see all the CEOs of the companies that are participating. You can message them directly there as well and have a conversation with them. So as part of today's event, not only do we have some exciting companies that are presenting, both on, as I mentioned, the high growth and also the high yield aspect, we've also got some great keynote presentations as well, covering different areas such as crypto, such as venture, etc., to give you a bit of an insight into some other perspective of what's happening in the markets at the moment. Now, I encourage you to stay to the end because that's when I'm going to be giving my talk. I'm going to be giving you a unique perspective across all the different aspects that we see, covering venture, covering private equity, covering private credit, and also covering digital assets as well. Now, just to be clear, we have seen a tremendous increase of enthusiasm in the markets over the last month. Literally within the last week, in the week following the US elections, we saw a $2 trillion of value created in the markets. And that's a really bullish signal for us as investors and also for us as business builders. So make sure you stay to the end of my presentation, you'll enjoy it. And on that note, enjoy the Capital HQ Online Investment Showcase.
Hello, my name is Steve Seeley, Chairman and a founding shareholder of Hope Capital Limited, a company set up with my son Jonathan some 13 years ago. I'm here today to tell you a little bit about our company, what we do and how we have grown up over the years, and also explain to you about our current fixed income investment opportunity which yields 10% per year over a 36-month period. So what do we do here at Hope Capital? Well, we are a specialist provider of non-regulated bridging loans in the UK of up to 18 months, secured by a first charge over a particular residential, commercial or semi-commercial property that we lend on. Bridging finance, as it's known in the UK, is an £8 billion sector and is used by property developers where normal banking arrangements on finance cannot be utilised. Established by our family money in 2011, we quickly grew using our own funds and latterly other high net worth and family office money. In 2018, we brought in our first institutional funder and then last year brought in our second. We are currently talking to two others. Since inception, we have lent over 300 million to our borrowers and our loan book currently stands at £75 million. So why are we different? First and foremost, we have excellent people. Based in the northwest of England, we have an extensive team of 35 consisting of sales, marketing, underwriting, loan management and together with our own HR and legal departments. Our unique approach to the market makes us one of the leading players in our sector, both in terms of customer satisfaction and award-winning service. Speed and surety of funding is our USP, unique selling proposition. And whether it be for a refurbishment, a capital raise or an auction purchase, we are one of the fastest funders in the market. That said, I always say it's very easy to lend money to people, but the hard part is how do you get it back? Well, at Hope Capital we have an extensive risk mitigation strategy for all our loans. Each deal is secured against the first legal charge on the property concerned, together with personal guarantees on the borrower and a power of attorney over all their assets should they default. Now, most of our loans are around 12 months and 80% redeem on time. Some borrowers do extend, and this is fine as long as we can agree new terms. But in the very rare cases that a borrower truly defaults, we act very quickly. We appoint a land and property receiver, seize control of the property and assets concerned, and sell them off at the very first available auction. Now, I must stress that these cases are very rare indeed, but we are proud of the fact that in over 13 years of business, we have not lost any capital whatsoever on any deal. A key fact is that we always define the exit strategy on any loan prior to the lend, and we monitor each loan throughout its term, paying monthly visits to the property in question, ensuring that agreed milestones are met by the borrower. We have further security by the fact that our average loan size is relatively small, around £300,000 to £400,000 each, and that we only lend up to 75% of the value of any particular property. We always, therefore, have at least 25% equity headroom in each loan. So how can you be part of our story? Well, Hope Capital is in the next phase of their growth plan, and we want to give you, as an investor, an opportunity to co-invest alongside us in our growth. We wish to grow our loan book to £100 million over the next 18 months, and to do this, we need to raise up to £50 million from high net worth individuals. This will be on a fixed term basis, fully secured until the end of 2026. And we will pay out interest at a rate of 10% per annum each and every quarter. The investment, which will be deployed over our loan book portfolio, will be secured by a set of legal documents. giving a debenture and first ranking over the relevant SPV, together with the comfort of knowing that our money is in each deal, and that in the unlikely event of default, Hope Capital takes first loss. So, in summary, we are going to give you the chance to invest in a strong, well-established company with an excellent track record. We are looking for a minimum ticket of £100,000 and we will pay interest quarterly at a rate of 10% per annum. We have our own money in each deal and offer security by debenture and massive headroom in the loan book. Our current loan book is in great shape and our pipeline is as big as it's ever been. If you would like to participate in this opportunity or would like further information, please do not hesitate to contact me using the on-screen details. Thank you for listening. I look forward to hearing from you soon.
Hello everybody, my name is Sven and I'm one of the 3 founders from the company Sigan from Zurich in Switzerland. And today you're going to learn a little bit about our business model, which is called Next Level Power Electronics as a Service. So we have 3 innovation areas. The first one is the technology as such, which comes as a modular platform, high tech, deep tech, whatever you name it. The second part is we have an innovative business model, which is basically a license model, and people, they are using this deep tech. They don't have to pay us upfront, but during a license while they are using it in their products. And the third one is this modular technology platform is good for many different customers. And then out of this, they share a basic R&D platform, which is an alliance approach. And out of this, we have a unique offer for ODMs and OEMs, which have products in various markets. We will see that in a second. And basically the power electronics behind is what we deal with. So let's see what it means. So if we have this use case here, a house with photovoltaic and a local battery storage, you need an inverter to handle all of this. And this inverter is the product from our customers. It's the ODMs or OEMs. And inside this product, we have power electronics. And that also belongs to these ODMs and OEMs. Now, what we do is we are designing this power electronics for them. And this on the basis of our platform called MMIP. And the service we do is called Power Electronics as a Service. So we are far behind, and that's also why we call Sigan inside, because we are on the supply chain in the background. We are the technology providers. Now, if you look where our power electronics is relevant in terms of energy transition, you're going to find out that almost in everything you have power electronics as one of the key cornerstones to make it happen. And because it's like this, there are many customers from our side, means the product owners and the product market players, they have problems and they have solutions, but we are solving their major problems, which is power electronics design, which is having good experts for these power electronics designs, and dealing with certifications and cost optimization, because these power electronics are typically a majority stake of the costs of such products. So far, they had the question, do we make such in-house R&D? Do we go for Asian black box standard stuff? And now we have a new solution and we say, no, join us with this MMIP approach and save a lot of R&D costs, a lot of time to market, and a lot of cost for the product, and enhance it with new functionalities. And that's our 4 USPs to our customers. Now, looking how this works, this MMIP has 3 levels of modularization, and basically it's an approach the automotive guys also run. And this is the first time that electronic is based on such a modularization with multiple levels approach. And we have taken some years of development to come to this point, but it's not a stop area, it's a continuous development of such technologies and providing them always to our customers. These reflects in many technical USPs from electronics, inverter system products in OEM, but it's a bit too short to go in details now, but there are many USPs to follow such an approach from a technical perspective, but also from a business perspective. We have all these developments, which is the iceberg already done, and there is this little product-specific development here, which basically reflects different areas of our free license fee. And all this together gives the SIGA license fee, but that's a calculation we do product specific for the OEM or the ODM, how much license fee they have to pay. Now, looking at the markets, we have so many different markets which use power electronics, but we are decided to start with battery home energy storage, residential market, which is a large market, but also a very competitive market. If we make it there, we're gonna make it everywhere, is our strong estimation. And this is all here the secondary market we call. Looking at the primary market, we have already quite a good market field of 1.5 million units per year in 2030 in Europe. And all the second market is another 1 million units per year in Europe. So all of that, if we are considering 15 and 5% market share only, which obviously we try to be better than this, we got about 26 million of revenues in 2030 on our baseline scenario. And when we look how these things come to the customer, means the product owner, we are signing framework contracts. We are starting with them some engineering activities. It goes into production. And that's what we want, because this green thing is the thing we are looking for. It's actually the license fee, while the blue one is some pre-fee for development of their specific products. Now, looking at this blue thing here in 2024 and 5, it's major, but starting 2026 and 2027, we see that the green license fee is the, let's say, major thing, and that is the thing what gives the hockey stick, and by that the break-even is forecasted in 2026. For this, we need a bit more money, and that's why I'm looking this video, because we are open for another 2 million of investment. However, there could be also raised in smaller ticket sizes, because our existing investors constantly invest in us, but have the wish to bring 1, 2, 3 people more on board to share the knowledge and the opportunity. Our business status is quite good in terms of technology, in terms of sales pipeline. You can look at in more details, as well as our team. We are 12 core team members here in Zurich, and we are really the core of the cream in this field. Our history is already there. We are a spin-off from a different company, and today we are ready to basically accelerate here this hockey stick with the support from you. And finally, our Power Electronics Alliance idea is really to bring the Europeans, but also, let's say, the Western world together to handle power electronics in a new way. And everybody is welcome to join here as a potential member. That's about it. And our investor's bio is already very recognizable. And for this, I say goodbye from this moment, and I'm happy to talk to you soon. Bye-bye.
Hello, I'm Val. I'm a co-investor, co-founder, and executive chairman of Angara. I'd be glad to tell you today what we are building and what we have already achieved. I will make sure it is as simple as possible. However, there will be elements of complexity. To put it simply, for those of you who are familiar with Palantir technologies or the AI and big data analytics landscape, we are building a Palantir in industrial equipment. In other words, we have built an AI platform that enhances the productivity of industrial assets in heat transfer related processes with the full power of AI, as it should be in the factory of the future. The problem we are solving is really big and practical. The inefficiencies caused by fouling alone results in $100 billion in annual losses and 1 billion tons of CO2 emissions. This layer of fouling you see here in the picture, or dirt, acts as a barrier to efficient heat transfer. And transferring heat is the main and the only job of a heat exchanger. There are zillions of heat exchangers in these industries you see on the right-hand side, and they don't perform well, the heat exchangers. The market opportunity we are unlocking exceeds $50 billion at scale. Our goal is to bring our decarbonics AI platform to many other markets except those where we already commercialized it, which are refining and petrochemicals. The application markets are numerous, but we have our clear priorities. And some of you can help us on this journey. We are a professional, dedicated, close-knit team. We have worked together for 7 years, and we have invested $3 million in cash of our own money. We've built our skills in IBM, IHS, Halliburton, McKinsey, Morgan Stanley. We are supported by a board of wise and experienced and committed advisors. We have proven product market fit with growing revenues from customers. This year, it is already more than $1 million in sales in ARR, or 210% growth over last year. Next year, we're going to make $5 million in sales. Our IP is protected with 40 patents already granted, which were valued at $23 million by a leading global IP expert firm, Metis Partners. And we are part of JP Morgan's Green Economy banking platform. This is an illustration of how some elements of our decarbonics AI platform look like. This dashboard shows a customer what will happen to his production unit performance in 1 year's time, well in advance, and what this customer should do in order to save $9.2 million. We have already saved millions of dollars for our customers, and there will be billions of dollars in savings at scale. Customers pay a subscription fee for our analytics as a service. We deliver them tailored data insights and actionable intelligence on a recurring basis. There are no direct competitors. Somewhat similar players focus on predicting risks and optimizing performance, doing predictive analytics, also with dashboards, but within traditional business as usual framework. In contrast, Angara maximizes asset performance and exceeds baseline productivity by integrating the capabilities of the latest technologies into our analysis and generation of actionable insights. The deployment of our platform requires the engagement of a prospect on several layers and takes about a year. At scale, it could be less than that, like half a year. We already signed an enterprise-wide master contract with some clients, and we are very close to signing a few more already in the beginning of the next year. Now, we are raising $5 million to get to profitability within the next 18 months' time and scale further and further and go global. To do this, we need to add 10 people to our team in technical sales support and in IT, like data analysts, so that we can deploy our technology faster to already engaged customers. We're offering investors two choices: direct equity or a convertible loan with a valuation cap, interest and discount, with a minimum check of $50,000. Exit strategy consists of two elements. Primary exit, we aspire to achieve within the next 3-5 years. It's going to be a trade sale to one of the leading automation companies. An interim exit that can be achieved within 2 years focuses on our other technology stack, which we can sell or for example, on a exclusive global license basis. That will constitute another trade sale to an industrial services or chemical company. We estimate the primary exit valuation to exceed $1 billion, while the interim exit can generate $100 to $250 million for the shareholders. In terms of our fundraising, we already received $1 million and we have another $4 million left. So you're welcome to consider joining us. And I'd be happy to speak with those of you who are already interested in supporting us on this journey. And thank you for your attention.
Did you know that in 2020, according to UN Global Migration Statistics, over 280 million people were international migrants? That's almost 4% of the world's population living abroad worldwide. This makes international migration a key feature of our world and a central issue of globalization. Last year, the United States issued 45 million visas, the majority of them being tourist visas, 4 million for business needs and over 1 million for students. In the US, students infused $3 billion into the economy and created over 350,000 jobs. The US, with UK, Canada, France, Australia, received more than 3.2 million student visas. Global mobility and migration is a fact of today's world. As commonplace as international migration is, it is not simple. Almost every applicant needs migration advice to get into their destination country. Applying for a visa is not an easy task. There are many challenges. Traditional migration advice is rife with excessive bureaucracy, inefficiencies, delays and frustrations. A refusal or delay in the process brings devastating consequences to applicants and their families. Visa regulations are unknown or too complex for the applicant, and visa decisions seem very arbitrary. Here are some of the complaints we hear most often. They are not familiar nor experienced with their destination country's visa laws and regulations. They are not fluent enough in the language of their destination country to understand the legal terms and phasing. They are uncertain about what are the applicable regulations that pertain to them. The web is inundated with contradictory and outdated information. They get confused by the legal lingo. They lack experience with the process. Migration advice is expensive and scarce. It depends on the availability of the migration consultant and on his level of expertise and dedication. They resent the lack of communication with their advisor. Interviews with consuls are unpredictable and confusing. MyVisa.ai solves these problems. My6sa.ai is a platform and mobile application that uses advanced algorithms and machine learning to analyze visa applications and their related documents. Because MyVisa has been trained with all migration regulations and policies, as well as a multitude past visa decisions, it is able to provide the best migration advice, identifying potential issues and deficiencies. MyVisa then provides precise, personalized recommendations to each applicant based on their specific situation. It also gives you what percentage chance of success that your visa will be granted. What if the percentage isn't very high? MyVisa also assesses the applicant's profile versus various countries' requirements to identify a country where they may be more welcomed. Additionally, MyVisa also helps the applicant train with chatbot to rehearse the interview with the consul, and helps in the composition of statements of purpose and genuine study intentions documents. The MyVisa application is extremely versatile. It provides advice on several visas including student, graduate, business, family, tourist, and many other visa subclasses for an ever-expanding list of countries. MyVisa.ai founders Juan Rincon and Leonardo Passion and Thomas Skidmore come from diverse backgrounds that bring a wealth of knowledge and experience to the table. Rincon is the co-founder of RC Migration and RC International Education, the largest Australian migration agency in Latin America. He has 16 years of experience as a lawyer and migration agent with RC Migration. Juan holds an MBA degree from Monash University. Pak Hun is the CEO of Warne Enterprises, a scientific-based company dedicated to developing tools from both natural and data sciences, as well as their substantial experience in AI to deliver solutions to business problems. Leo holds a PhD in physics, postdoctoral fellow at University of Toronto and Harvard University. Tom, accounting executive with over 20 years of experience in audit and corporate finance. Thomas has expertise in GAAP, IFRS, SEC reporting, in the technology arena at entities from international concerns to startups. Thomas holds a Bachelor's of Science in Accounting from the University of Central Florida. Presently, there are no competitors in this space, with any offering remotely similar to MyVisa's. The migration advice industry has customarily been provided by migration lawyers and consultants that range from sole practitioners to large global corporations. They offer assistance to its clients by offering individual consulting services. This is expensive and often not a very responsive process. In the tourist visa space, specifically, there are some apps that offer assistance in applying for a tourist visa. These sites do not offer migration advice based on the applicant's individual documents and situation. The MyVisa advantage. Given the recent trends in technology, artificial intelligence will eventually supplant all traditional migration advice providers. This inevitability will be a major disruptor in the industry. MyVisa.ai, an early innovator, will be a first mover, offering a unique, best-in-class product. MyVisa.ai is the first to use the power of machine learning to eliminate the inadequacies of traditional migration advice. MyVisa.ai is available 24/7 in the comfort of your home or at your favorite cafe from your phone. Provides migration advice in an ever-expanding list of languages. Is faster and more accurate than traditional consultations. Provides tailored recommendations. Can assess the user against several jurisdictions, is truly a global solution. Business model and strategy. We aim to capture 0.02% of the market in the first year and increase our participation toward the 2.5% in the fifth year, generating gross revenues for $6 million in the first year and for $76 million in the fifth year. MyVisa has three basic sources of revenue. Usage fee, paid the individuals that use the platform. Advertising revenue, our platform will offer space to companies related with international travel such insurance companies, student accommodation, and others. Brokerage fee, complex cases and special needs will be referred to a list of selected migration firms who pay for the referral. You are invited to invest in the early stages of this endeavor that will forever change the way the people around the world travel and manage their visas. Currently, there are 2 or 3 companies offering some sort of assistance with visitors' visa applications. The largest is iVisa, that generates $68 million a year in revenue with 370 employees. At myvisa.ai, the use of AI tools make us significantly more efficient and profitable.
Hello everybody. Sustainable Fashion Ventures is an early stage company currently completing a Series A capital raise. Over the course of today, I'm going to cover the three main challenges in the fashion industry: the opportunity, the numbers, the product, and the 2-year growth strategy. Every day, 50% of the global population wears denim. The mission of Sustainable Fashion Ventures is to commercialise the world's most sustainable and durable 100% cotton denims. The key problem in sustainability today is plastics. If you look at plastics as a whole, the number one challenge is consumer packaging. Think Coca-Cola, Pepsi, Master Foods. The second challenge, which no one's talking about, is the fashion industry. If you can see that slide there, you'll be looking at a pair of skinny leg jeans. Skinny leg jeans typically has 3 to 10% elastane in there, which when it's worn and torn and washed, abrades and releases microplastics, typically through wastewater and sewage into the oceans, which in turn leads into protein sources which are ingested by humans, leading to respiratory failure and cancer. The second major challenge in fashion today is scaling recycling efforts. To date, the venture in the United States of America has partnered with recycling providers such as Blue Jeans Goes Green and has successfully recycled thousands of kilos of denim. We are an early stage promoter of these services. The venture itself will continue to promote these services with partners in jurisdictions around the world to accelerate the use of recycling services, particularly for denim. Labour and modern slavery. So most cotton grown today, which is the primary component in a denim garment, is grown in emerging economies where they do not use machinery and advanced techniques to farm cotton. The venture itself will be working with the world's most advanced cotton farms. This not only ensures that the labour used in the farming processes is lawful, but it also means the complete reduction of insecticides and pesticides, which have been proven to destroy the biomass surrounding the farms. The opportunity. The opportunity is to use aggressive digital sales and marketing techniques to commercialise the world's most sustainable denims direct to consumer online, and to be number one in denim online today. The numbers. Denim's a compelling market to disrupt. Currently today, denim is about $85 billion in revenue direct to consumer. The market itself, as you can see there, is growing at a compound annual growth rate of 5%. That means today, in Australian terms, denim is 10.5 times larger than export beef, which is our largest agricultural export, and it's actually larger than iron ore, which is our largest export overall. Growth of denim sales online is estimated to continue the compound annual growth rate of 12.5%. The reason for this is simple. The economics of direct-to-consumer businesses demand that they go online, particularly regarding the cost of staff and rent in the first world economies. The product. So the venture itself is the first in the world to develop 100% cotton alternatives for all major plastic use cases in the denim supply chain. We've successfully registered the green tab. This was an incredible and hard to describe result. It took over 2.5 years in court with Levi Strauss & Co. in America. Very thrilled to announce we've successfully registered those green tabs for the three major use cases being storm, tough and stretch. And we're the first globally online to commercialise recycling processes. The strategy. So the direct-to-consumer business is going to be executed through online marketplaces. These online marketplaces have already proven to rank top 5 in the United States, and we have successfully sold garments throughout Europe, the United States, and Asia Pacific. Localising content and centralising pricing and operations. So the strategy is to build a centralised team in a low-cost economy, bring in influencers from these denim purchasing jurisdictions, create the digital content, and then redistribute out from the centralised location, getting the advantage of really low-cost, high-quality people and facilities in emerging economies. Continue to be the leading innovator in sustainable materials and processes. That's really building on our partnership with Cotton Incorporated, who is the world's top research and development organisation for cotton and thereon denim. Top 3 growth drivers: the transition to online. We hold top 5 SEO. The use of funds includes rolling this website out to the 16 top jurisdictions for denim sales. That will ensure not only the performance of our primary asset through the rolling out of these websites and the highly valuable backlinks, but will also ensure that we can continue that localization strategy in each jurisdiction, working with local influencers to promote the product. The dominance of denim, we lead innovation in denim. We were the first globally to remove plastics from the denim supply chain at a prototype level. Use of funds includes rolling those materials into commercialization. Emerging economies driving growth, China, Japan, Brazil, India. One key question that keeps getting asked is, can an Australian company compete? Well, we've got fantastic relationships with these countries. They are within our region, and the establishment of the global headquarters in northern Vietnam gives us direct access from a logistics perspective to the two major markets here, with a deep sea port, access to Japan and Brazil. The 2-year plan, year one. So it's a fairly simple plan. We're going to roll out these digital assets globally, establish a headquarters and corporate structures, begin scaling sales and marketing. To date, sales and marketing efforts have been done entirely digitally, and we have achieved $2.40 in revenue for $1.20 in sales and marketing expense. The headquarters location, we've sourced leases in the north of Vietnam, and we've settled on a location in a place called Hai Phong. The Vietnamese government, through their contract, has granted 5 years tax-free, 5 years under 4%. Hai Phong itself is a logistics hub, direct access to China, direct access to India, a deep sea port with international free trade agreements. The establishment of enterprise roles, when you're building a high growth, direct to consumer business, anybody who's got a background in AI and basically the automation of digital process, establishment of enterprise roles is critical to the successful growth beyond the $100 million mark. Year two really sees the development of a digital production studio. Think of a sort of a suite of little movie sets where we can bring in influencers, we can record marketing promotional materials, we can cut those into various file types, distribute them back out via TikTok, YouTube, whatever it might be. Increasing the sales and marketing cadence. Digital sales and marketing is a lot easier than traditional marketing in the sense that increasing expense is as simple as increasing expense if you've got the right assets behind you. High profile marketing partnerships. So breaking into some first world economies, obviously those economies have saturated messaging from a marketing point of view, seeking to work with high profile people who understand the product and the impact of removing plastics from the denim supply chain will be critical to ensuring our success in those first world economies, which make up over 30% of denim sales globally. Invest. So Series A, 500,000 common shares at $10. Use of funds, as discussed, a 2-year plan to roll out global websites ranking top 5 all around the world in the primary denim purchasing jurisdictions. The development of a world-class digital production studio, execution of a direct-to-consumer sales and marketing plan, and then the ongoing commercialization of the world's most sustainable 100% cotton denims. Thank you.
Hi, my name's Panos Miltiadou from Prime Financial Group here in Melbourne. Today I want to talk to you about our Hawthorn residential development investment opportunity that we currently have in the preferred equity orientated capital stack. Before we get started, our disclaimer can be found in the information memorandum that you can download via the Wholesale Investor. This is not intended to be advice, and you should look at this when you get the opportunity via the IM. A bit about me. My name's Panos Miltiadou. I'm a partner in the property team. I've been working in the sector now for close to 15 years, and 10 years of that being with my own residential property development business. Delivered in excess of $270 million of completed projects, 77 million construction, 168 million in current pipeline projects, and Prime has invested through its client base $45 million over the course of that period in our projects. Over 155 million of supported senior bank lending to deliver our projects over the course of time. So the reason that I joined Prime is to assist in locating and finding the best opportunities and ensuring that our clients are protected through risk-adjusted returns. About Prime. So established in 1998, Prime has over 190 team members, multi-divisional firm, $1.2 billion of funds under management, offering accounting advice, self-managed super fund advice, capital and asset management advice, as well as preferred and alternative investing. we service mainly high net worth and family groups, as well as sophisticated investors. Preferred equity, what is it? So in the context of this project, preferred equity is an equity that comes in higher in the waterfall than the sponsor's equity, as well as the profit. So in a traditional development sense, senior debt is utilised to help settle land. Senior debt is also utilised to assist in construction funding. We take a preferred equity position, which has additional security, unregistered mortgages, personal guarantees, general security arrangements, and it's bringing mechanisms to protect clients. So in the context of the waterfall, you'll have your profit, and in this case, over $7 million of profit. You'll have the sponsor's equity, which again, in this case, is $3 million, before you get to our clients' invested funds, as well as their return. So it's ensuring that we rank higher in the return profile to that of the developer and their profit. So the current opportunity I'd like to talk to you today about is 148 to 152 Riversdale Road in Hawthorn. It sits on the corner of Koot Road in Hawthorn, arguably one of the better streets in Melbourne, ideally located, great resale values, and supported by amenity, parks, and connected shopping. The opportunity today is for a preferred equity position in which we are supporting an experienced fund manager and developer. That developer has sought finance from Australian Unity Debt Funder. The debt funder will assist in the construction costs over the course of a 20-month program. We have a 24-month term with this investment, thus allowing at least a four-month buffer. Aspire Construction Group have been appointed. They're a great builder with a good balance sheet, great capabilities, and the ability to obviously service the project through the course. We ensure that we do our due diligence on builders, considering it's been one of the most talked about components of the development cycle in recent times. The project is launching sales and construction at the same time. The idea behind that is to show future buyers and downsizers in particular that the site's progressing beyond that of off-the-plan sales. The project partners include an off-the-plan sales agent with great capability, has sold in the area previously, and has supported the gross revenue expectations of the project, as well as that of an independent valuer to support those values. Again, the term as mentioned is 24 months, and we're sponsor aligned, $3.3 million of equity and $7 million of forecasted profit. If we factor in contingency in the project and assume it has been spent, then at $9 million first loss protection to investors. Delivering 19 luxury apartments in one of the most prestigious areas, serviced with great internal amenity like swimming pools, hot spas, cold spa, and sauna, as well as a mix of 2, 3, and 4-bedroom homes, all well appointed and all specifically designed for an owner-occupier downsizer, which has been the predominant markets in the local terms. The preferred equity position is 15% per annum to investors with a 24-month term. To date, we at Prime have raised $4.3 million, so 55% filled to this point. To give you a quick understanding of completed investments, we've completed a recent project and had investor returns distributed for a project in Elizabeth Bay, New South Wales, 21 high-end downsizer apartments, again, continuing the theme of downsizing as the predominant market across the eastern seaboard. $2.1 million of capital was raised for this investment. It was a 31-month term, and our investors took the benefit of a 15% per annum return. We've recently completed a project in Paran, 9 townhomes, $5.5 million was the raise, 31-month term, returning 10.5%. The rationale behind a lower return was that this was instigated during the days of less than 1% return in terms of interest rates. Gilby, New South Wales, is an example of a current project. It's an industrial warehouse with a sponsor that's delivered 5 times prior in terms of this sort of stock as well as sales journey. It's an ordinary equity investment of $4 million. The term's 24 months. And again, based on the current nature of developing, 18 to 28% return is the expectation. Currently, this project sits $1 million ahead of its budget, hence the increase in return per annum, as well as 3 months ahead of project program. So how do you invest? The minimum investment is $50,000 for this opportunity. You have to be a wholesale investor. You can download the full information memorandum via Wholesale Investor, so online. In that document, it provides a lot more detail to that I've been able to provide in this short video. But things like sales and marketing strategy, location, comparable sales, builder capability, as well as fund manager understandings. We can be contacted in one of 3 of our offices in Victoria, New South Wales, and Queensland. But the best way to make contact is through wholesale@primefinancial.com.au. We'd be happy to talk to you and answer any questions you may have about the development and the investment. Thank you for watching.
Hello, my name's Sam, and together with my colleague Bruce, today we'd like to introduce you to the opportunity to invest in the ReadySet short-term rental fund. This is our disclaimer, and we encourage you to pause the video to read through. Let's start with the team. Who's responsible for managing this fund? So Bruce Davey, or Dr. Bruce Davey, is the Managing Director. Bruce has a PhD in mathematics from the University of Melbourne and has built up and sold 2 successful businesses, Optimal Decisions Group and Fastmail.fm, prior to founding and developing ReadySet in 2016 and the fund in 2019. Fund is the first in Australia to utilise the sharing economy business model to make efficient use of residential real estate through short-term rentals such as Airbnb, Booking.com and Stays. Bruce has also been developing HedgeMonkey, a privately held trading company, since 2020 and when COVID hit Melbourne. Myself, Sam Hawkins, the Business Development Manager, I have approximately 25 years personal investing experience, as well as experience in a family property portfolio, including developing, operating and selling a motel, various residential, industrial and commercial properties, as well as experience with residential colleges. And I've also previously owned and operated my own direct investment property for around 10 years. So I have experienced those visits to VCAT to recover rent, the unnecessarily and costly repairs, removing rubbish and post-vacating cleans, but I do know that it is a wonderful way to invest. We also have our operations and property team, who are currently managing approximately 50 properties throughout Victoria with a mandate to expand nationally. Over their 8 years of operations, they have managed over 50,000 guests who have booked over 200,000 booking nights. And our professional responsible entity is Primary Securities and non-correlated group. So what led Bruce to starting ReadySet? And if we were in a presentation room today and we asked for a show of hands for those who have booked or hosted accommodation through Airbnb or another short-term rental platform, we know that there is a large number of respondents in that category, which is wonderful because it is a familiar business model to most people. Functions these days, whether it's family, friends or professional, everyone seems to want to talk about their investments and their property and the capital growth or the yield. They're trying to get ahead in life. Short-term rentals are indeed one way to maximise property yields. The takeaway from these functions is that the Great Australian Property Dream is indeed alive and well, and it's probably encouraged by our culture. TV shows such as The Block, magazines such as Better Homes and Gardens, shopping with Bunnings, hobbies such as DIY and podcasts, among many other things. Having stayed in Airbnbs personally all over the world, and having leased out an investment property and having rented a spare room on Airbnb, in my experience, short-term rentals do make sense. So the question, can I get a higher return from my investment property? At ReadySet, we say yes. Can I gain exposure to a wider variety of property to diversify my portfolio? At ReadySet, we say yes. Can I reduce the the administrative and risk burden associated with direct property investment? At Ready Set, we say yes. Ready Set short-term rental fund aims to do these things. So what is it? The Ready Set short-term rental fund is an REIT focused on residential property operated as short-term rentals. It's an open-ended, unlisted wholesale unit trust. It's backed by equity in the property with a higher anticipated return from the short-term rentals. It targets quarterly distributions and redemptions to investors. And I'll now pass over to Bruce for more details on the fund.
Thank you, Sam. So Sam's covered the what. We're an investment fund focused on short-term rentals. Let me give you the 2-minute version of why you might get your exposure to residential property through a managed fund. The first reason is workload. There's actually a fair bit of work, even with a great property manager, in looking after an investment property. If you want to build a portfolio, it scales up. And if you want to do short-term rental, you've also got cleaners and furniture and guests to wrangle to add to that workload. Some investors try and skip some of this workload. For example, a common sin of direct property investors is to only look at 2 or 3 or 4 properties before making a purchase. Compare that to what a professional does. We might crunch the numbers on 50 to 100 properties to make offers on the ones we see as the best, so we can make the best purchasing decision we can. Probably the biggest reason is expertise. Short-term rental is very leveraged to expertise. Let me give you a comparison with long-term rentals. I'm sitting here in Melbourne CBD at the moment. If I was to find a 1-bedroom apartment 1 block to my north and another 1-bedroom apartment 1 block to my south, different buildings, different styling, different agents, different decisions made by those agents. But do you know what? On average, the rent received by the owners of those 2 1-bedroom apartments, most of the time will be within 5% of each other. This situation is absolutely not the case for short-term rentals. The data I have on the screen here comes from a service we subscribe to called AirDNA. AirDNA tracked the performance of short-term rentals around the world. I keyed in when we were preparing for this presentation Melbourne CBD, and here's the first 8 of the 4,500 search results that came up. I was really struck by the difference between the 4 properties that it happened to have on the first row of search results and the next 4 properties it has on the second row of search results. The vast majority of them are 1-bedroom apartments, but the stark difference is that the revenue brought in by the properties on that second row is nearly double the revenue of those properties. Right? All bar one are 1-bedroom apartments, and in fact, the only 2-bedroom apartment in these search results is on the first row, the poor performing row. So all of those decisions about short-term rentals, where do you list it? How do you list it? How do you price it? Because of course we don't charge the same price every night for a short-term rental. How do we interact with the customers? All of those decisions have a big impact on the performance of a short-term rental. And so I'd not encourage people to go into short-term rental thinking, oh, anybody can do this. Investing through a fund helps you get access to a team that's been doing this for 7+ years and has a lot of experience and expertise in the space. Here's a quick summary of what we have to offer. A couple of things to specifically point out. Firstly, we have both a wholesale fund and a retail feeder fund, hence the fairly wide range of investment sizes that we can accommodate with our setup. We're a property fund, so this is something appropriate for investors for the medium to long term, not short term investment. Finally, we're an open-ended fund, so there is the facility for you to add to your investment over time. If you have any questions, please don't hesitate to reach out to us. We're more than happy to help you out. Thank you very much for your time.
Hi, my name's Evan Thornley. I'm the co-founder of Longview. We are a 10-year-old business with about 120 professionals. We do nothing but residential property. We think we know more about capital growth in residential property than anyone else in the country. We manage 4,000 rental properties for clients. Our buying advisory team have bought 1,000 properties each in the last 20 years. Our data science team has analysed every sale price of every property in Australia for 50 years. So what I wanted to do was share with you what we've learnt over those last 10 years as what I believe is the top ranked rental property manager in the country. So we know more about property investors and their properties and their challenges than anybody else. Here's the thing. Up until now, if you want to invest in the capital growth of Australian homes, the only way you can do that is by being a landlord. Now, that is difficult, expensive, time-consuming, and risky. Now, there is a different opportunity, which I'll share with you today, which we've created after seeing all of the challenges that landlords have. So now you can invest across residential property with diversification across a large number of assets rather than only owning one or two. And you can do that without the costs, taxes and hassles of being a landlord. You can invest across Sydney, Melbourne and Brisbane and get access to the capital growth in properties in all three of those markets. So the Longview Home Equity Fund, which I'll take you through today, is a way of investing across family homes in Sydney, Melbourne and Brisbane. Our target returns are a 14% internal rate of return over a 10-year period. And we believe we can deliver those returns without having any debt or in the fund at all. When I talk about residential property, a lot of people think that they're invested in residential property when really they're invested in something else. It's $11 trillion, the residential property market in Australia. Just 3% of that is new property development. And you can invest in funds in every layer of the capital stack there, in companies, in private credit, in a whole range of things. But that's really investing in a manufacturing business that makes new properties. You can invest in mortgage debt against those properties, the big banks, the hybrids and everything associated with that. That's 22% of the asset class. But again, you're not really investing in property. You're investing in the credit quality of people who live in those properties. The property is there as a security, but that's really any increase in value in the property has nothing to do with you as the investor. So to invest in the actual homes or in the capital growth that drives those homes, there are no investment grade funds right now, and yet that's the biggest portion of residential property. 3/4 of the whole asset class, $8 trillion, and yet the only way to invest in that for capital growth currently is by being a landlord. And believe me, it's the capital growth that you want to invest in. Every property market is a trade-off between capital growth and rental yield. And the Australian residential property market, particularly in Sydney, Melbourne and Brisbane, is close to the best capital growth market in the world, which also means it's one of the least attractive rental yield markets in the world. So if you're going to invest in residential property, you're going to want to do so with a focus on capital growth. But understand how huge that opportunity is. Just this last year, in just 1 year, the capital growth on Australian residential property was almost as large as the entire federal government budget. $624 billion in 1 year versus $680 billion for the entire federal government budget. That amount is 4 times the size of all the earnings of every company listed on the Australian Stock Exchange combined. So the biggest wealth engine in the country is capital growth on Australia's homes, and yet there's no easy way to invest in that other than being a landlord, and that is not an easy way. So if you were to invest in Australian residential property for capital growth, you'd have to choose the right homes. Now, what our analysis has shown is just 17% of homes, 1 in 6 homes, actually generate more than half of all the capital growth in Australia. We have a name for those homes. We call them Rodwells, robust, older dwellings on well-located land. Another way of saying we invest in dirt disguised as houses because land appreciates and buildings depreciate. So the properties that have got the best capital growth are the ones where there's solid older homes there, but the real value is in the land underneath them. These types of homes, these are homes in our fund right now across Sydney, Melbourne, and Brisbane. Actually, there's 55 homes already in our fund, ranging in value from just under $1 million to just over $6 million. So you can invest across a diversified portfolio of those homes and get a surprisingly strong return because of the unique way in which we invest. We're not buying these homes to rent them out. We're co-investing with the people that own them. So by giving equity to people who are either buying a home, becoming the bank of mum and dad for a new home buyer, or people who are in a home but want to get access to some of their home equity, we do a unique deal with those clients. We offer them equity. This is not a bank loan. There is no interest rate. There's no monthly repayments, but we'll offer them equity of, let's say, 10% of the value of the home. In the case of $1 million home here, that'd be $100,000. And they will give us in return that money back and 1/3 of their future capital growth. And so our investors only make $1 if the homeowner makes $2, so our interests are aligned, and we will only do this in homes that get really strong capital growth. And as a consequence, you get very strong returns without any bank debt at all, so none of the cost or risk of bank debt or interest rate exposure, and yet you're in a portfolio of high quality assets. You have none of the costs and hassles of being a landlord. The homeowner looks after the home. They pay the maintenance, the insurance, the rates, everything as they always would. They tend to look after the home better because they're the homeowner. So by investing through shared equity offerings with existing homeowners in only high quality homes, we can generate surprisingly strong returns with very little of the risk that you would have in investing in your own. Across a portfolio of 200 homes, which is our target for this fund, those homes will sell or the owners will buy back from the fund every year from year 3 onwards. And so it actually generates surprisingly strong cash flows. On our modelling, about 15% money on money returns from year 3 right through to the end of a 10-year period. The management team and the investment team are seasoned professionals, both in residential property and funds management. My co-founder, Anthony Cohen, and I, who've been building this business for 10 years, our chairman, James Hook, who ran a $6 billion infrastructure business for Macquarie, and Joe Scottney, a senior ANZ property banker, Ryan Levin, who built the property business at Wingate, large private credit fund. So it's a senior team that's overseeing these investments to make sure you're invested in the right homes. So this is the only way that you can invest across Australian homes in one place without the costs, taxes, and hassles of being a landlord, and get access to a target return of 14% on your money, despite the fact that there's no debt in the fund. So if you'd like to learn more, follow up with my colleague Matt Newham at Longview, and we can tell you more about the Homes Investment Fund.
Hello, thank you for your interest in FOI. We are a MICE company, which stands for Meeting, Incentive, Conference and Exhibition. Allow me to introduce what FOI is about. We are a Singapore company that was incorporated in February 2023. We started with almost nothing. Very little money, no office, no equipment, and don't have the needed manpower. By the end of December 2023, just 11 months after our incorporation, we were profitable with a revenue of $1.83 million USD. In order for us to grow the company exponentially within the next 5 years, we need to develop what we call MICE Plus services. So what is this MICE Plus services is about? It's about developing intellectual property services to capture a larger market. And that's the reason why we're here today. We are asking for 10 million equity or debt financing for the next 5 years. For the first 2 years, we will be concentrating on building and enhancing the core business revenue and begin our intellectual property development on the MICE Plus services. And year 2 to year 5, which is second phase, we will concentrate on the IP growth and fundraising. The second round of fundraise will be held in this phase 2. The reason is to provide additional financials to give the final push to our revenue and also to validate our valuations. And on the last phase, we will plan for IPO in about 5 years. Our revenue is contributed by 50% from events, 25% from logistics, 15% from conferences, and 10% from others, which include exhibitions, sports, permanent setup, design, and branding. The projected, the completed projects. The completed projects for FY 2023 was $1.85 million, and with the ongoing projects for the first half of FY 2024 of $1.48 million, we are having a total revenue of $3.33 million since the beginning of our incorporations until June 2024. And with immediate reachable projects that's coming up of about $1.15 million, we are expecting the revenue to be around $2 to $3 million. Our key customers is government and from different government agencies such as CDC, PA, LTA, MHA, HPB, and others. According to the market research, the worldwide value is estimated to be $904 billion as of 2023 and is expected to hit $1.9 trillion by 2032. And for Asia Pacific, the current value is about $184 billion and expected to hit $873 billion by 2034. And the China market is expected to hit $162 billion by 2030. There is a lot of value and liquidity in the market, a lot of projects available, but we need more enhanced MICE services. With the traditional MICE services, we will not be able to capitalize the market, and therefore we need to build our intellectual property shows and events where we have controls on when do we roll out all these shows and events. Some examples of what all these intellectual property shows and events are about is, for example, in IP exhibitions, you got this Avatar, the exhibitions that was held at the Gardens by the Bay in Singapore in 2022 to 2023. IP Carnival held by AIA Carnival Winter Wonderland in 2023 in Hong Kong. What we plan to do is to develop our own IP developments, such as Winter Wonderlands Singapore, sports and such as marathons and triathlon, IP future games such as League of Legends, building of theme parks, and these theme parks, at least in Rabbit Hole in Vietnam, is a theme park that we've been involved in when we're in our previous company. Another examples of building IP events is these developments of these generation mask exhibitions, which we will collaborate with Australian designer with endorsement from NASA to develop exhibitions based on mask. Our financial projection for year 1 is 21 million of revenue and 1.3 million of profit, and 68 million of revenue in year 5 with 6 million of profit. The reason why we are confident with this projection is because we have shown that we are able to be profitable in year 1 from incorporations. And not only that, the main reasons is because we will be using the bulk of the fund to make selective acquisitions on some of the target companies that we have already spoken with who are interested to come on board to allow us to take majority control. And these companies are with order books, and when we buy these companies, we are immediately able to take advantage of their revenues and profits. And therefore, the projections that we have shown here is highly achievable. This is how we intend to utilize the fund. 30% will go to M&A of selective uh, assets, and 5% will go marketing, 15% will reorganize the company, 6% will be used on development of the IP, and 44% will be used as working capital to support the ongoing projects. My partner and myself have been in the industry for several years. I've been holding C-level positions for various businesses, and I'm also an associate lecturer at the Singapore University of Social Sciences, and I'm also a certified fraud examiner, expert witness, and fellow at the Singapore Institute of Arbitrators with 22 years of experience. And my co-founder, Joel Fu, has also been in the business for many years. He has unique skills in Singapore and China in developing theme parks with 24 years of experience. The reason why you should invest in us is because we have proven track records. It is very rare that a startup company will generate revenues immediately upon incorporation, and we are profitable within year one. As you could see that the market is very conducive, high values around the world, providing excellent opportunity for the mines industry to grow exponentially. As mentioned earlier, in the M&A plan, where we target to buy selective company, these companies are with very specialized skill sets that would enable us to build our intellectual property events and sports and shows. And that would allow us to bring in tremendous value of projects. And that would beef up the valuations of the company through higher project values. And therefore, as far as capability is concerned, we are all ready to go. With the involvement of the intellectual property events and show, we will be able to bring in high margin projects, and therefore we will experience lucrative growth. We have experienced a team of employee together with us, the management team, and we'll continue to build the team with the necessary capabilities to develop the Minds Plus services to capture a larger market share. With that, thank you very much. Please feel free to contact me. Give me a call or WhatsApp or email. And please scan this QR code to get instant access to the deal room for more information. Thank you very much for your time.
Hi, good morning, everybody. Ravi here from Roller Robotics. Very happy to be here. I think just to introduce ourselves, we are reimagining kitchens, and let me tell you why. There is a global crisis in the food service industry as we see it. In the US, there are 1 million job openings. Wages are going up to $20 an hour. Rentals are increasing. I think there's something that people don't really understand, but individuals don't want to do this job anymore, right? So then the cost of retraining, etc. And sunk costs are incredibly high in this industry. So if you've picked a location for a restaurant, the likelihood of it surviving more than 3 years is only about 30%, and that's a total write-off on your investment. So in addition, rent and labor represents 50% of a P&L in this industry. And that's ultimately driving costs up for consumers and prices. And add to that inflation through the wars, through supply chains, climate chains, etc. So it's also important to note it's only getting worse. And what I mean by that is students or the younger generation, as I said, don't wish to do this job anymore. They can make more money on TikTok than working at a fryer on a Friday night. So, and we, second derivative, we went back into the training schools. We're seeing students are not signing up for this industry. So we decided to, my co-founder, Tushar, and I, who's standing over there, we came in from Singapore. We decided to reimagine kitchens where robots and humans essentially work together in harmony whilst powering sustainability and affordability. And I think that's very, very important. A little bit of background on myself. I come from the food industry, so I know this pain point very well. My background is as an engineer, chemical and industrial, but was in the finance industry with Credit Suisse, as well as Cadbury Schweppes in a supply chain and manufacturing role. I've built food businesses, up to 60, 70 million in enterprise value in the past. So, but like I said, I know the pain point. I know where the puck is going to be. My co-founder, Tushar, has deployed robots around the world, 3,000 plus to be exact, over 35 countries over 4 years. Essentially autonomous cleaning robots. So again, interesting use cases of where many things can go wrong. For us, sorry, the font's not so clear here, but we've optimized not for scale as a team, but essentially building a team that can really deliver. And what we mean by that is in design and manufacturing, regulatory and compliance, fleet management, of course, domain expertise across robotics as well as food, and IP strategy being a very important part as we scale. So 4 months after starting the company, we built the world's first autonomous fast food kiosk prototype. It was a hypothesis that we had, and we launched it, like I said, without an idea of what we were going to do, but we did it. And the response was phenomenal. We tested a hypothesis, put it out there, and consumers loved what we were building. And not only consumers, but the ecosystem within the food industry. And what I mean by that is the largest restaurant groups, the biggest kitchen equipment manufacturers, who could see how our software and hardware stack would disrupt and change the industry. So 4 months later, we said we've got to actually deliver a unit, and that's what we did. From idea to revenue in 11 months. And we filed 3 utility patents, 4 more in the process. And most importantly, we attained regulatory approval where robots can actually run fully autonomous restaurants. So I think, again, going back to the problem statement, what we're able to do is scale fast, where our solutions are essentially plug and play with one PowerPoint. No exhaust, no sunk costs up front. Health and safety certified. 48 square feet in size, so lower rental footprints. Order to dispatch, what I mean by that is e-commerce enabled, digitally friendly, integrated with Deliveroo, Uber Eats, Foodpanda. So you've now got a system that can operate 24/7 without human involvement from a cooking workflow perspective. What are consumers saying? I think is always interesting. So again, as we launched, we launched last week, so the verdict is still fully out, but the early signs have been very, very encouraging. So again, excitement around the technology, but most of all around food quality and the service, because food is not a customer acquisition business, it is a retention business. How do we get people to keep buying the product? What do the economics look like? I think that's important. The early signs that we're doing 120 meals a day, $6 AOV, that's 21,000 Singapore dollars in revenue, leading to a store EBITDA of 38%. The traditional restaurant, best in class, is 18 to 20%. So we're able to now accelerate, almost double that, with a payback in 6 months. Again, these are projections, so we all know it's worth a bottle of scotch more so than the paper it's written on. But I think it is important. We do believe that with the setup and infrastructure and the team and the ecosystem that we're building, we will be able to hit and deploy 1,000 units in the next 5 years. We're actually in Australia to sign a contract to go into the mining industry, which again is a great deployment opportunity for us in this space. Which also leads on to where we feel that this system can be deployed. We see educational institutions in the Singapore market. There are 375 schools, 18 institutions of higher learning. Again, where throughput may not be the most important thing, but ultimately gives us points of deployment. Transport hubs, we're in talks with the world's largest duty-free retailer concessionaire in Europe. Again, express interest to put these systems at gates in high mobility areas. Institutional caterers, so that's your Sodexos, Compasses of the world. Petrol stations, we think, again, that's another opportunity where, underutilized space that can now be provide extra revenue for asset owners. That applies to convenience retail and hospitals. Not on this slide, as we've also inked an NDA and now in the process of developing autonomous solutions to go into this kiosk for the world's largest restaurant company. Not bad for an 11-month-old startup. How do we manage at scale? I think this is, again, if we're to achieve those unit economics, deliver 1,000 robots, how do we do that? At its core is our tech stack associated with fleet management. We are able to track every single item in this box, right? What's happening, where things are going right, where things are going wrong. We're able to see temperature, the chillers, the freezers, so food safety, etc., is also built in. And of course, sales tracking and analytics, which I think has been around for a long time. We do believe in the ecosystem, I think, for us to be able to deliver at scale. So we've had strategic deployment with conversations and moving forward with the Heinemann Group, Civeo, the Far East Organization, which is the largest real estate group in Singapore. From a kitchen equipment perspective, we're working with Panasonic and also Rationale. So where our software stack would be able to control this kitchen equipment. So again, that future where human culinary craft and robotics come together. From an F&B perspective, we've deployed first in Singapore with Foodstar Kitchens. From a manufacturing and financing perspective, again, very encouraging for a company as young as ours to be able to have garnered interest from SMBC, Japan's largest bank, to essentially provide asset-backed financing to our customers. So we can now reduce the friction of purchases of this equipment where it's a fully robotics as a service subscription model. In addition, on the food side, we're working with the world's largest chicken supplier, CP Foods. So again, great validation for an 11-month-old company. What's next? We've obviously solved for fried chicken and the fry workflow. That's a $35 billion market size. We are close to finishing the pizza workflow in the next couple of months, along with the pasta and the wok workflow. So this allows us to expand our culinary offering to more customers. I'll ask, the market landscape is not large, but there are a few players already in the game. Hyphen, which is in the US, with one pilot test, the last round valuation was $300 million. Miso Robotics, which is doing frying in restaurants, but not totally autonomous systems. These two are more like appliances. It's a $250 million company. Circus Group, with one pilot in Europe, is almost a 500 million euro company. Again, so investors see this as the future of the food industry. It's coming whether we like it or not. From our perspective, we are revenue generative. We're looking at 20 million Sing as our valuation going forward on a pre-money basis. Raising $3 million, I think at its core, really engineering and talent and deployment. IP filing is expensive as an exercise, so we realize we need to protect ourselves on that. And then, of course, the deployment of kiosks. But with that, we recognize we're here. We'd love to meet strategic partners from a deployment, education, healthcare perspective. Again, petrol stations, convenience stores. So, let's reimagine kitchens together and look forward to meeting later today. Thank you very much.
Welcome to Earth Point, where we're going to show you how our brand new, patented international blockchain payment and reward currency is going to change marketing and loyalty forever, because it's much more than a normal marketing and loyalty system. It's a full profit system for businesses where the businesses only pay when the customer pays them and the clicks are free. So what's the problem every venture capital asks? Well, in Australia, we send over $5 billion every year to Facebook, and we send over $7.2 billion a year to Google, all to attract customers within about a 1 mile radius of all the local businesses. That works out to $8.38 for every man, woman and child in Australia. If we extrapolate those figures to the UK, that's £38 billion per annum, all to attract customers within a mile. Think about that. That's £750 million per week out of local UK communities. That's a problem, because from that $38 billion, which is sending overseas, they pay almost no tax. Nothing goes to the environment, nothing goes to the community, nothing goes to humanitarian causes. It creates almost no jobs in the UK. There's nothing goes to customer loyalty, because they don't want customers to be loyal, because they make profits from shifting customers from one business to another and then back again, because you're not getting another 10 million customers in the UK very quickly. There's also nothing goes to what the customer cares about, so it's very difficult to shift a customer from one business to another unless it's all about discounting, which means that businesses are making less profits. How does it work? Well, in phase 1 of the Earthpoint system, we get businesses to join for a very low upfront fee. Their customers then join for free, and according to KPMG, over 85% of a business's growth, and therefore profits, come from loyal customers. But yet most businesses can't even contact their customers to make them loyal. The Earthpoint system enables businesses to send their customers special offers via push notifications in the apps, free of charge. A restaurant could send out free entree or dessert of a Tuesday, getting its customers to come back again and again. It goes direct to the customer's phone and watch. And the business only pays just 3% of the sale when the customer walks in and pays that business. Phase 2. We allow other businesses to send out your special offers, non-competitive businesses. So a hairdresser could send out, hope you enjoyed your haircut, it looked fantastic, get a free entree or dessert on me at Bob's restaurant, the tiramisu is fantastic. Goes straight to the customer's phone and watch, so they get the attention. The restaurant pays 3% when the customer pays them. The hairdresser doesn't cost them anything. The customer gets a benefit. Everybody's happy. Phase 3. We allow clubs, churches and charities who are always desperate for funding to send out the business's special offers straight to their supporters. Could be, kids had a great game of soccer on the weekend. Give them a free meal at Bob's restaurant. On me as the hairdresser. Straight to the customers, the phones, watches, the restaurant pays 3%, the eco shares in the revenue, the hairdresser looks great and customer gets a benefit. Everybody wins. Revenue sharing. 20% of the customer, 20% of the customer's nominated eco, 20% of the environment, 20% of the referral network, which could be a bank or a sales organisation, 20% to Earthpoints Limited, and we keep any unpaid fees. With 10 million customers, that means we would, from just £167 worth of spending each week, we would earn £5 per week per customer, which is £50 million per week, which means £10 million per week would go back to customers who spend it back in the UK economy. £10 million would go to their nominated ecos, their soccer clubs, their churches, their charities. £10 million per week back to the environment. £10 million per week going to sales organisations and referrals. £10 million per week to Earthpoints Limited, and basically all of that money is staying in the UK economy, doing good in the world and creating jobs for the UK, benefiting the UK. The technology is operating now. You can walk into a business, use your credit card through either your phone or app or just the credit card. There's no extra steps for the cashier or the customer, and the customer will know, here I am paying with my watch, I will know that I've earned Earth points before the cashier does. here it is. This is how much I've earned in earth points from the business. I can see where I've spent all my money, where I've earned earth points. I can see where it's all going. The charities can see where it's all going. And the business can see that they got a lot from this soccer club. They didn't get any from that netball club. And they know where now to target their next lot of marketing through the other businesses and through the other organisations. Our milestones are we're currently partnered with Oracle Corporation to look after our servers and security and databases. Every business in the UK can be part of the system. That means every sale in the UK you can earn earth points on. That's both B2C and B2B customers. We not only reward customers, but we allow them to pay with earth points through either the gift card system for big businesses, which means no extra hardware or software, or through the Biz app for small businesses. We also solve ESG profitable because part of our fee goes to humanitarian, community, environmental causes, enabling the businesses to solve their ESG obligations profitably. We get big data on purchasing, not just on search, which we've got a search feature. And that means through AI, we can predict where customers are going to purchase next and what they're doing. We have an operational domestic digital currency in Australia. We are not a security under UK, US or EU law. We have a licensed digital currency exchange in Australia, which can operate in the UK. We are offering 25% of the UK company for £2.5 million, and we have an IPO as an exit strategy. Thank you for your time. If you've got any questions, please don't hesitate to ask.
Hi everyone, thank you for joining me today. We are diving deep into a groundbreaking medical technology that's set to revolutionize cardiac rhythm management. And I'm joined by Andrew Shute, the Senior Vice President of EBR Systems, a company that's quite literally transforming how we approach heart failure treatment. Andrew, thanks for joining me today.
Many thanks for the invite, Rhythm.
Absolutely, it's a pleasure. Now, to set the stage for our viewers, EBR Systems has developed the Wise CRT system, a remarkable device about the size of a grain of rice that's poised to revolutionize how we approach cardiac resynchronization therapy. So let's dive right in. Now, the technology, Andrew, is at the heart of your innovation, which is quite literal. Let's start the interview by discussing how does the Wise CRT system's leadless, ultra-compact design provide a significant technological advantage over current cardiac resynchronization therapies?
Yeah, well, thanks. So all pacing devices, whether they are maybe pacemakers to treat slow heart rate, implantable defibrillators to shock or cardiovert patients, or cardiac resynchronization or CRT devices, they've traditionally relied upon leads or wires to deliver the electrical stimulus to the heart muscle. Now, these leads enter via a vein under the collarbone and travel to the heart. And they've long been the Achilles heel of pacing systems. And the leads, once they're implanted, they can migrate, resulting in a loss of pacing. The wire inside the lead can fracture due to repetitive motion. And specifically for cardiac resynchronization or CRT devices, the lead must be placed in a vein on the outside of the heart to avoid development of blood clots, which can result in stroke. So to address these limitations, the CRM market or cardiac rhythm management market has been moving towards leadless pacemakers and leadless ICDs. However, our YCRT system is the only leadless technology that could be placed inside the left ventricle to treat heart failure. And that's because these other leadless devices are around 20 times larger than ours. So if they were implanted into the left ventricle, they'd likely be thrombogenic, causing clots, which could then in turn cause a stroke. But in contrast, our device becomes completely endothelialized, or rather the heart's own tissue grows over and completely encapsulates it in about 30 to 45 days, removing any risk of clot formation. But importantly, as we are a CRT device to treat heart failure, we are not directly competing with these other leadless pacemakers, which are just used for bradycardia or treating a slow heart rate. In fact, we're complementary. around 30% of all pacemaker patients go on to develop something called pacing-induced heart failure within about 4 years. And these patients then require what's called an upgrade to CRT, and our WISE device provides the only means to upgrade these other leadless pacemakers to CRT.
I understand. That's truly very fascinating, Andrew, and it's clear that such innovation doesn't emerge in a vacuum. Now, you have identified a substantial market opportunity that must be driving this technological breakthrough. So your company has identified $3.6 billion US market opportunity. So can you walk us through this market potential?
Yeah, that's great. And that 3.6 billion is just in the US market. I'd just like to clarify. And this is actually made up of 4 segments. And the first 2 are for treating patients that are considered previously untreated, meaning they failed conventional lead-based CRT. And these are acute lead failures. So these are where during the implant, they were unable to implant the lead that paces the left ventricle. Then we've got chronic lead failures. So these patients had a successful implant, but however, the pacing lead subsequently either fractured, migrated, or needed to be programmed off. The next group is called high-risk upgrades. So these are these pacemaker patients I referred to who develop pacing-induced heart failure that require an upgrade to CRT. Now, there's a large subset of these that due to their risk of infection or vascular occlusion, or they have other comorbidities such as diabetes or renal failure, the WISE upgrade can be used to avoid vascular and pocket-related complications in those patients. And the 4th patient we just touched on is leadless upgrades. And this segment is growing rapidly and really driven by the high growth rate and adoption of leadless pacemakers. And as we just mentioned, leadless pacemakers are complementary to us as we provide the only solution to upgrade those 30% of patients who develop pacing-induced heart failure to CRT.
Now, Andrew, what's particularly compelling about medical innovations is their ability to genuinely improve patient outcomes. So could you elaborate on how the WISE system's ability to reduce left ventricular and systolic volume in heart failure patients represents a breakthrough in treatment?
Yeah, thanks. Well, firstly, left ventricular and systolic volume, I guess you consider that a measure of the heart's efficiency. So it's a measure of how much blood is left in the heart at the end of the contraction phase. So the less blood there is, the more efficient the heart is, and resulting in a greater cardiac output. And studies have shown that a 10% reduction can result in improvements in both longevity and quality of life for a patient. Now, results from our CRT study were presented at the Heart Rhythm Society meeting last year and then published in JAMA Cardiology in July this year. And the headline result was an amazing 16.4% reduction in left ventricular and systolic volume. So to give some context to this, our study only enrolled patients who had previously failed lead-based CRT, or they were deemed too high risk for lead-based CRT. So it's a fairly tough group of patients to treat. And so we clearly exceeded that benchmark set by other studies of 10% by having a 16.4% reduction.
Mm-hmm. Your clinical results definitely sound promising, and it sounds like that you're ready to bring this to the market. Now, for my next question, what are the key strategic considerations in your US expansion plan? And specifically, how does EBR Systems plan to capture the market share, particularly within those top 252 hospitals?
Yeah, thanks. Well, the interesting thing about the US, it's a really highly concentrated market of high volume accounts. So there's around 1,900 hospitals in the US that implant CRT devices, but 50% of the entire market's in that top 252 accounts that you referenced. So our first year of commercialization will really be considered a limited market release. So in phase 1, we'll plan to target those sites that participated in our SOLVE study. And here we can leverage our existing relationships with these study sites to streamline patient identification and the implant procedure. So our initial focus here will be on building a sustainable utilization rate. So we're going to be initially targeting 2 implants per site per month. And once we start to achieve that, we'll then move on to phase 2 of our limited market release. And here we'll target high volume sites where we already have strong engagement from implanters. And then finally, we move into the full commercialization phase, targeting those additional 200 sites that make up that top 50% of the entire US market. So to support this, we intend to use a direct sales force. So we've already identified high-performing sales reps, and these are primarily existing contacts of either Eric Strandberg, our Chief Commercial Officer, or Mike Manassi, our US Sales Director. And these are reps they've worked with previously, and these tend to be individuals that specialize in introducing new technology into the market. And the right sales rep is really crucial to drive utilization. So during an implant, they can be 2 hours shoulder to shoulder with an implanter. It's a great chance for them to build rapport, maybe discuss a challenging implant they've recently had. After the procedure, they can look at the implant book and identify patients that may have had a failed CRT lead implant. They can call in on the cath lab manager, maybe look at the case list for the next few weeks to identify some other high-risk cases that could be converted to wires. And then on their way out of the clinic, they can go down to the pacemaker clinic, and I help to identify those patients that recently had their left ventricular, their CRT lead programmed off. And all this is to help drive, internal referrals.
Mm-hmm. Amazing. Now, Andrew, innovation doesn't stop with one breakthrough, as we understand. And I'm really intrigued by your development of a new rechargeable battery for the CRT system. Can you tell us how might this innovation expand your market potential and treatment capabilities?
Yeah, well, rechargeable battery is a really exciting product development area for us. And we'll be the first cardiac rhythm management company to introduce a rechargeable battery. And they're quite common today in things like neurostimulation for chronic pain. And our move has really been driven by feedback from our implanters and patients. It'll use induction charging similar to how you charge your mobile phone. And this will really help to remove barriers to widespread adoption. It'll have a 66% reduction in size, so it's going to improve the comfort for a patient, and it reduces the need for future battery replacements. So in lieu of a replacement procedure every 4 to 4.5 years, the patient will simply recharge their device for 1 to 2 hours every week or two.
Wow, amazing. That's a wonderful step moving forward. Now, Andrew, as we look ahead, 2024 has been a significant year for EBR systems. So can you walk us through the key milestones EBR has achieved in 2024 and what are your primary strategic goals for the coming year for 2025?
Yeah, so one of the key milestones that we hit in July was publication of the SOLVE results in JAMA Cardiology that I mentioned earlier. This has a really broad reach. It's a high impact factor journal, a lot of scientific credibility. Interestingly, we've received some feedback from the journal of the reach that it's actually had. There's an independent group called Altmetric that track research outputs across all scientific journals. And they notified us that our article was in the top 10% of all research outputs ever tracked. So this is measuring the quality and quantity of online attention that the articles had. So I think that bodes well for reach and awareness amongst the wider scientific community. The other big milestone was at the end of August, where we submitted our 5th and final module to the FDA as part of our PMA submission. The FDA notified us that they'd begun their substantial review within 30 days rather than the customary 45. And that bodes really well, I think, for the rest of the review cycle. And as we look ahead, we're expecting FDA approval early next year. Then following this, we'll begin execution of our commercialization plans. So reimbursement will be established, retraining of physicians on the implant procedure, and then we begin initial commercial cases in the US. Outside the US, we'll initiate 2 important clinical studies. The firstly is TLC, or totally leadless CRT, and this will really support our transition from treating previously failed patients to becoming first-line therapy, and this is by treating newly diagnosed heart failure patients. So this will involve implanting a leadless pacemaker alongside wires to deliver totally leadless CRT. The second study is called Access CRT, and this will build on our early work using the WISE system to pace the heart's own conduction system leadlessly, and this will enhance the clinical utility or application of the WISE system. And then finally, the other big milestone for next year will be expansion of our manufacturing facility. And this will allow us to increase our margins by continuing our transition away from contract manufacturers towards bringing in-house the full manufacture of our transmitter and electrode.
Amazing. Well, I would like to thank you, Andrew, for providing such comprehensive insights today. What you and your team at EBR are doing is indeed truly remarkable, not just developing a medical technology, but offering hope to patients with few other options. To our viewers and listeners at Wholesale Investor, this is more than just an investment opportunity. It's a chance to support a technology that could fundamentally change how we approach heart failure treatment. So please feel free to reach out to the team at EBR Systems. And Andrew, once again, thank you for joining me today in this conversation.
No, and thanks again for the opportunity, Rhythm. We always look forward to any chance we've got to share our story with the wider investment community. Thank you.
Wonderful. Thank you.
Good morning, everyone. As spoken, my name is James, and I'm one of the founders of Origin Plus. Now, I usually start with a bit of no one will know what's happening in the room in the photo behind me, but in the room, there's a few people that were at the presentation a few weeks ago, so don't jump in there because you do know. What is happening here is the day the first barcode was scanned in Ohio in 1974. It was done on a Wrigley's chewing gum like I have in my hand today, and this isn't a stage prop for people who have seen this presentation. I did buy it this morning with the same same barcode on the back of it. Now, right now, an equally defining moment in time is afoot, and that is the 2027 Sunrise initiative of GS1. So GS1 is the standards provider of barcodes, and they have undertaken the ambitious task of converting the traditional barcode into a QR code. That movement has been happening for some time now, several years, but it's really starting to come into the forelight of it occurring by 2027. Now, on the original barcode, standardization occurred. It drove efficiencies across all elements of trade across the globe. On the back of that standard, a lot of enterprise systems, the largest Fortune 500 companies of today, built their enterprise systems on the back of that standard. Now, the actual standard, as in the code, does not change, just the format it is presented in. And why is it changing? It's changing because of a response to consumer demands. Consumers are now demanding more transparency around the products that they are consuming. People want to know what's going in their body, how it affects their body, how it affects the environment around them. And as a result of that, GS1 is an industry-backed organisation, not for profit, and the industry, being retailers, are the ones that are championing in this change. So on the other side of that demand coin are brands. Food and beverage brands who we service are demanding greater connectivity to their consumers. And then we have another force supporting this change, and that's legislation change. Already occurring in Europe is mandated traceability across a number of categories. Similarly, in America, the FDA has their food traceability initiatives that are mandating traceability across a number of categories, and that is only increasing. So we have two forces that are culminating together to form a catalyst for an emerging industry. That emerging industry is connected packaging. Now, the connected packaging industry is tipped to be worth $45 billion in the next 5 years. And to no surprise, I imagine you guessed it, we are a connected packaging platform. So at Origin Plus, we service food and beverage brands across the globe by helping them better inform, connect, and reward their consumers. Now, we do that through a number of features that connect to a QR code. The QR code, let's not overplay that, is a connection point. It is a connection point to a bigger feature set of traceability, loyalty programs, competitions, verified documents, among many other things that simply cannot be put on packaging. So therefore, the QR code creates a connection point to surface this information to consumers. Now, our journey as Origin Plus isn't one of a typical software company, because we actually started as a food and beverage brand. Back in 2018, we had a problem. We were exporting to the world, and consumers lack confidence in our supply chain, and they lack confidence in supply chains in general. Now, food traceability isn't a new concept. It's always been around. Every company that you have has to be able to recall their product, so they have to know where it came from, and there is an element of traceability. What we found as a young company, food brand exporting to the world, is the ability to surface that information to consumers was the gap. Okay, so to be able to have real-time verification of the origins of a product was where there was no solution that we could use, so we went about developing our own. On that journey, so we were the first to apply a agricultural supply chain to a blockchain and track that from farm to fork across 2 continents. And we didn't stop there, because as a food brand, we also suffered from another gripe that is common and still a gripe of food and beverage brands to this day. Wholesale food and beverage brands do not know who their consumer is. We did not know our consumer. The retailers that we were selling to absolutely knew the consumer. At the point of sale, there is a connection point and they get to meet the consumer. We did not, albeit that our product travels through the world in its packaging, lands in the hands of a consumer, but we did not know them, so we went about changing that also. Inside the QR code that was servicing all of our traceable supply chain, all of our verification of product, we laid in pack level loyalty. And we changed the game. We built a loyal consumer base across numerous countries on the back of a loyalty program connected to the packaging. We had developed a very, very powerful QR code system. Now, on a parallel runway, while we were in market developing our systems and servicing consumers across the world, GS1 were developing the 2027 Sunrise Initiative that I've already mentioned. Right now, GS1 are out there across the globe. So this isn't a standards change in Australia and America. This is a standards change in every country, whether it's Egypt or any country in the world is going about it. And every single organisation, GS1 organisation, is out there promoting the benefits of QR codes. The benefits of QR codes that they are promoting are traceability, transparency, verification of documents, loyalty programs and competitions. Everything that we've already developed, everything we've already developed and put into market for other food and beverage brands. And so it made absolute sense that we are a GS1 solutions provider. GS1 is a standards provider, and they're very open in the way that they approach the market. They do not create solutions, they have solution providers, and hence we are one of those. Right now, there is a huge once-in-a-generational change occurring. The demand for connected packaging platform systems is emerging. It's already on its way. We have the right product to capture this demand, but more excitingly, we have the right team to scale across the globe and be a number one player in the marketplace. Part of our team, we have 2 of the ex-CEOs of the world's largest loyalty programs. One is the one that's well known down here in Australia, which is Flybuys. That's John. Kai, probably not too many people would be aware of Payback, but Payback is a European equivalent of Flybuys and sort of started in Germany and then grew across the world into India and other places. And our CTO, Nath, was one of the founding engineers at Airbnb. So standing here as an ex-food brand, now connected packaging platform founder, I can tell you when you have to have a 4x4 centimetre space on your packaging dedicated to something that just goes beep at the checkout, when you have the opportunity now to layer in extra information that can help you win at a shelf, you're going to want to do it, and you're going to want to make sure that that QR code will have mass impact, and that's what we do. We help brands win. And why we're here today, we're here, like all the businesses, we are raising capital. We're raising $1.5 million. We've already got 450,000 of that committed, so just over $1 million left to do. If you're curious around our product, our team, and where we see our company is going to be in the next 24 months, please come and see us. Reece, one of the other founders, is here, so I didn't actually run through our bio that had up on the screen because you can come and see us out in the room. Thank you very much for your time and have a great day.
But hi guys, thank you very much for coming this morning. My name is Matt Graham. I am the CEO and founder of InSquare. Today I'm going to talk about a square and how it has endless possibilities, not only in health and fitness, but also as an investment. So let's set the scene. What is InSquare? InSquare is a world first smart force deck which measures upward force and downward force for functional body weight movements, resistive strength movements, isometric movements, and balance movements, all in a compact 1 square metre with only 4 centimetres high. We have a prototype out here which you can come and have a look at, and it's applicable to all ages and all abilities. Now, why is this important? Because there's a big problem. 80% of adolescents and 31% of adults don't meet the World Health Organization's daily activity standards. And this problem's only going to get worse. Think about it. When we were kids, we used to ride bikes. We used to come home when the street lights went on. Well, it doesn't happen anymore. Kids now are on their phones. And worse still, they don't even ride a bike now. They press a button, the bike rides it for them. So, and this is causing a big issue globally. We have 1.8 billion inactive adults, and with 80% children being active, this is going to be a lot bigger in the future. 2.5 billion people are overweight, nearly 1 billion of those people are obese. And this causes, what I was alluded to before in some of the conversations, is this causes a massive health issue with cardiovascular disease, which kills more than twice as many people as any other disease globally. So what we're going to aim to do is we're going to aim to make movement medicine through sustainable, enjoyable, and accountable exercise. And how are we going to do that? This is all about disruption. We're going to disrupt an industry that for 150 years has no advancement in commercial connected cardio technology. You think about it. When you go to a gym, you're going to do cardio exercise, you're going to do a single movement, and you're going to do that repetitively for a long time. You're going to get on a bike, you're going to pedal. You're going to get a treadmill, you're going to run. If you're going to get on a rowing machine, you're going to row. If you want to do more than one movement, you actually have to go to 3 or 4 different machines. The last innovation in this space for cardio technology was 15 years ago with the introduction of the ski erg, again, based on a single repetitive movement. So meet InSquare, guys. In 1 square metre, we can measure hundreds of exercises and literally thousands of routines. We can take you from slam balls into running, into bicep curls, into push-ups, into lunges, into mountain climbers, whatever it is, balance movements, strength movements, and cardio movements combined. So no more monotonous single movements. And the device itself has an interactive display, lights that indicate your heart rate zone and your tempo, and it can all be operated by your foot and attached to monitors and apps and so forth. So we're smarter. What we're measuring is we're not just measuring repetitions, calories, tempo. We're actually measuring how much effort you applied, how much force you applied to that exercise. Did you actually did you perform with a lot of strength and acceleration, or just did you do it half-heartedly? And this opens us up to a lot of markets, and we'll get amazing amount of data for body weight movements, balance, isometrics, resistance, and it can all be delivered on a mobile app or through electronic media such as screens and computers. And when I said all ages, I mean it, whether it be an 8-year-old or an 80-year-old, whether you be on a Zimmer frame or a wheelchair, whether you be an everyday athlete or an extreme athlete, we can actually give you routines and exercises, and we can get performance data which is second to none. Because of that, we apply to all markets, and you can see those markets there. We're getting a lot of interest in the sports tech area because what we're doing is really opening some eyebrows. Because of that data, we're able to do tests. Imagine a world where instead of your children just doing maths tests and English tests, went to school and actually did a physical test. Why aren't we doing physical tests for children at school? Why aren't we giving them benchmarks and saying, okay, this is your grade, you need to improve on that grade? We're at the forefront of this type of technology. We can actually gamify this, put them together and have a big screen like this, and 4 of us can compete running, and then doing push-ups, then doing movements, and compete in a gamified format together. Or we can have competitions remotely, whether it be with your friend on the other end of a screen, or whether it be competitions within an organisation like HR department accumulating effort against the finance department. There's just endless possibilities for this. Classes, this could be full of InSquares, and we could have a big screen and we could all be competing with our data coming up live on the screen. You're accountable for what you do. If the instructor says do 200 steps, you do 200 steps. You can't cheat it. Remote training, for these outliers who don't want to go to a gym, we can actually send them to them. We can take the gym to them. The data can be pushed back to a dashboard in the gym. We can get preemptive tests. Remember, we can measure your weight. We measure your weight. So if your 80-year-old mother or grandmother, she's on the InSquare and all of a sudden she's lost 2 kilos, her strength has dropped 20% and her movement's reduced, that's a data push. That's a preemptive data push to family, friends, and physicians to say there could be something wrong. And this is all capable. Now, it's a big market. It's the connected fitness equipment market is $47 billion. This is going to grow double in the next 5 to 10 years. And now is the timing, because health is on people's mind. A McKinsey's report, they just interviewed 5,000 Chinese and US citizens, and 80% of them said wellness is their top priority. And why? Because it's a problem. So we can also address aged care markets, weight loss markets, schools, clubs, rehabilitation, defence. Our markets are endless. So we've got a lot of opportunity. And to go on that path, we've had some good traction. We have a 20-year patent. We've got 2 international patents pending. We have a signed distribution agreement, which is with one of the world's leading sports equipment distributors. They are here today. You'll hear from them. Matt, he's a really good guy. But this relationship is really important because it's not just distribution for us. He's also an investor in our product. And we share networks, we share systems, and most importantly, they make all our accessories for us. We're not in the business of making accessories. We're in the business of producing a fantastic platform which is going to impact the world. We rely on the experts to do the accessories and distribution for us. And that's Matt, who you'll hear from later on. We are well advanced with the industry growth program, where we're now applying for match funding. We're working with CSIRO, some really cool algorithms which will affect health, and you'll see some big announcements on health coming out this week from the Australian government. We've got B2B distribution relationships in France, letters of interest with international gym chains. We're making moves. We're pre-revenue, but I tell you, watch this space. I can stand here in front of you today and say in a year's time, it'll be a completely different story, maybe even months. So to do this, guys, I don't want to be the smartest guy in the room, right? I have to surround myself by people who are smart. Merrick Howes has come on as a cornerstone investor for us. He is not only our cornerstone investment, he also is our chairman. He was head of Anchorage Capital, which is a $23 billion US fund in Australia. He was head of Anchorage Capital in Australia. He started up Goldman Sachs in Australia, headed up the capital markets there. He started up Macquarie Bank Asia Pacific. But more importantly, he is a world record holder in rowing. And he sits on the board of Athletes Australia, sat on the board of Rowing Australia for 10 years. And these are the sort of people that we have guiding our ship. My other executive team member, Lee Finnier, he's an ASX-listed CEO. They're developing Australia's largest battery manufacturing company. And he has a doctorate in artificial intelligence. He's an investor and he sits on our executive board. I have Darren Carlin here with me today. He ran a $100 million commercial scale business, biggest in the Southern Hemisphere, for 15 years. He's here. He has manufacturing experience. He has operational experience. I have Matt Ward, also an investor. He's arguably Australia's best technical patent lawyer. He headed up Shelton IP. As an investor, he's written every patent with an invested interest. Alexandra Sloan, she headed up Meta Marketing for Asia Pacific. She's now marketing director at Optus. Kathy Gruzis, Chief Technology Officer at WetaFX. They make billion-dollar blockbusters, Avatar, Iron Man. Roger Westman, CEO of World Gym, a world industry leader in sports and fitness. Nicholas, who does all our data, he does all the data for Reserve Bank, IBM, Microsoft. I've got the team to help us take us to where we need to go. I understand the importance of that. From a competitive aspect, green is good on this slide. Whether it means, we're all movements, we're cardio strength, we're all markets, we're all abilities, we're space efficient, no moving parts, we're under 2,000 US dollars, and we've got incredible amounts of data that we capture. So we are an evolution. And this is what's been said to me by one of the world's leading foremost experts in sports technology, who's approached us and put us on a list of emerging companies to watch out for globally, one of 2 Australian companies on that list. Vauld has been measuring force plates. They measure athletic performance in AIS, jump height, and very, very complex data analytics. Vitruvian, another Australian company, they're electromagnetic pulleys, which is resistant strength. Now, those 2 companies in Australia alone have raised over 20 million US dollars, and they're segmented markets. They don't have the same market potential that we have. Tonal, that's just a machine that you put on the wall and you pull. It's a strength machine only. They've raised $500 million. Now, we're not talking about Australia here, guys. It goes back to what Steve said before. We're thinking globally. Our markets are huge. Tonal is $1 billion company, $500+ million raised so far. For Me is another strength-only product. They've raised $140 million US dollars, and they're operating only in the home fitness space. We're home fitness, we're commercial fitness, we're rehabilitation, we're aged care, we're weight loss, we're schools, we're defence. We are everything, and that's what's really important. This is why we're on the radar. So we're in our seed round. We've raised $1.1 million to date through all our rounds, but in this seed round so far, we've raised $650,000. We're asking for a minimum of $50,000 investment. It's an equity investment, and we're also an ESIC. So that if you don't understand what an ESIC is, it's an early stage innovation company. There are tax rebates and capital gains tax benefits to being an ESIC. We're going to spend money on on administration, research and development is a big part of our spend, and we're going to be, a lot of that's going to be our take to market in early next year when we'll be launching our MVP. And along that way, we'll have some R&D concessions come in. We're looking at doing a reward-based crowdfunding, not equity-based. We're not giving away equity, just early discounts on if you order sooner. And so there'll be money coming in along the way. Timeline is we've gone through the ideation phase. We've gone through the creation phase. What you'll see today is not the end product. It's the prototype that the MVP, which we'll be testing in markets, will be coming early next year. So we're very excited about that. As I said, we're doing some really cool things with CSIRO, which I can't tell you about unless we sign non-disclosure agreements. So, guys, as I said, I'm very excited to be here today. Please talk to me. There's a magnificent opportunity, and I say this with excitement. We can really make a difference in this world, and we can attack some massive markets, and I believe that we can be the first Australian sports technology startup unicorn. And that's been, not just me said that, but people are better than me that said that. But in the industry, experts have said that. So join the experience. Now's the time to get in. Thank you very much.
Hi, my name is Chris Ventura, and I'm the CEO of Harness Projects, a global education and talent company. We founded Harness Projects in 2018 to bridge the gap between education and employment. We believe in creating a world where individuals can showcase their unique abilities to employers, allowing companies to hire with confidence instead of gambling on unproven talent. So our mission is twofold. For our students, we solve the classic job experience conundrum. That is, you can't get the job without experience and you can't get experience without the job. And on the employment side, we help hiring managers try before they hire, observing talent perform in real-world working environments before making that critically important hiring decision. It's no surprise that AI is on track to reshape our future. And perhaps nowhere is this more pronounced than the future of education and work. Many will need to pivot into new career paths, and for those earlier in their careers who have had less opportunity to develop their workplace behavioral skills, the education to employment gap will continue to widen. Our model helps to build resilience against the disruption of AI by addressing this gap. So we designed a real project learning framework that directly integrates company projects into the student learning experience, providing real-world experience and skill training all within a single course. Project experiences are where we build not just our technical skills, but our behavioral skills as well. Things like critical thinking, resilience, and communication, the skills that make someone great to be a part of your team. In this example on screen, we have our 6-month UX design program, where students complete 3 projects with companies like HSBC, IKEA, and The Big Issue. And each project targets a specific technical skill area, whereas the entire experience develops their workplace behavioral skills. Our network of industry mentors guide these students through their projects and provide assessments on their employability across 36 technical and behavioral skills. Just like in real life, real-world experiences are the most effective ways to develop and evaluate our human skills. And we do this through our employability scorecard, a tool that we developed and this to assess and highlight performance across 36 technical and behavioral skills. The benchmarks for these skills was developed from input with some of the world's leading hiring managers in their fields, including from companies like Amazon, Meta, Qantas, Atlassian, Canva, and more. And we have developed these relationships over the last 6.5 years. It provides us access to a high set of quality industry data from some of the largest employment teams in Australia and the United States. Data like this is a significant opportunity for us as we provide deeper insights on talent that can't be found through traditional recruitment processes. Now, I've crammed a lot into this slide, and it's because we've done a lot. Over the past 6.5 years, we've partnered with over 125 companies, including leading brands like IKEA, HSBC, Qantas, Westpac, and many more. We've completed nearly 200 projects and expanded our programs from Australia to the US market. Our customer feedback is exceptional, with over 4.7 stars on Trustpilot, which is market leading for education. We've delivered projects in design, cybersecurity, product management, and digital marketing, and we've only just begun. We set some really strong foundations for scaling our model. The B2C side of our business has established a strong product market fit with 40% year-on-year revenue growth and 65% gross margin across 2 international markets. The next phase of completing our growth flywheel is the expansion of our real project experience framework to enable companies to use the framework as a turnkey talent solution. Now, we've already started to see this happen organically through the projects that we've delivered. We've had our companies come to us and say, wow, that person was incredible. Can I hire them? So we know that there is a strong need in the market for this approach. Coupling this with further investment in our tech to scale our data collection and provide hiring managers a new level of insight into candidate performance. Now, how many of you have hired someone only to feel that they weren't the right choice a few months into the role? Hiring managers often make decisions based on limited interviews, leading to a risk of bad hires and a lengthy onboarding process before someone is actually productive. We've all had this experience, no doubt. Our model changes this with a try before you hire approach, ensuring new talent can be chosen based on a robust set of experiential data touchpoints, producing a highly vetted and productive team member from day one. We call this a talent as a service model, which leverages all of the learnings from our real project courses and provides companies this turnkey talent solution. Candidates work on projects within the company's own business context, and we collect data points all the way through the project journey to give those hiring managers high confidence in their recruitment choice. Did the candidate communicate well? How did they take on opportunities for leadership? Did they demonstrate resilience and adaptability in difficult moments? This approach also ensures smoother onboarding as candidates already understand the company's culture and processes. Now, to ensure our company partners have access to all the deep insights that we collect on participant performance during a project, we are investing in an employability data platform. This is a platform that can surface workplace behavioral skills to hiring managers to help them make some really informed hiring choices. And we're able to do this because of the robust project experience framework that we've developed over the past 7 years. All the way through a participant's projects, we collect data on how they show up in their projects, their presentation skills, how they collaborate and demonstrate resilience, All of these skills then validated by industry-leading hiring managers who mentor the participants through the process. Now, one of the largest demand areas that we are hearing from our mentors and partners is in cybersecurity. Earlier this year, we launched our Cybersecurity Rule Project Experience Framework, and we are now the only company in the world with a fully project-based cybersecurity course from day one all the way through to graduation. The addressable cyber talent market across the US and Australia is calculated at $5.6 billion, and this is just one of the skill areas that we're targeting. Our goal is to have coverage across all the major high-growth digital skill areas as the world's global workforce is forced to pivot into new roles due to AI's disruptive effects. Now, Harness Projects occupies a unique space between traditional boot camps, universities, and talent provision services. Unlike boot camps that focus solely on training, we integrate real-world projects into our curriculum, allowing participants to develop their skills in a practical, hands-on environment. And unlike internship platforms or placement providers, we offer real-time visibility into a candidate's performance all the way through. This makes Harness a really logical choice for companies who don't have the resources to build and manage their own internship program. In 2025, we're focused on 5 key strategic initiatives. Our Talent as a Service product aims to sign on 5 cybersecurity pilot programs, allowing companies to trial candidates before hiring. We're developing our B2B2C tech platform to integrate both our models, providing transparency into candidate skills for hiring managers and a pathway to employment for the career changes. We're also continuing our investment in our employability scorecard and conducting further mapping on the experiential data points in our model. We're collaborating with the Digital Health Cooperative Research Centre and the University of Sydney to co-design a data science rule project framework, expanding our offerings into data science talent market. This last one is a really great example of some of the organic reach out that we're receiving from universities and governments alike about our unique model. And finally, we will be undergoing the accreditation process of each of our real project learning courses to open up fee help and government assistance for our students. Our team has a proven track record of tackling tough challenges. Over the past 6.5 years, we have built a world-first educational model and scaled this across Australia and the US. We've taken market share from highly funded VC-backed competitors, and we've done this as a bootstrapped company. We've raised a small family and friends round in 2022 as we brought on our board of advisors, and we're now well positioned to take a meaningful step to fuel the reach of our model. My co-founder, Mike O'Brien, has over 25 years of experience in education and academia. My background has been in digital product management as former head of digital at Laureate Universities, and I bring a commercial and product lens to the work that we do. We've been really fortunate to have guidance from some exceptional advisors, including the former MD of Seek Education, former MD of Spotify and Peloton Australia, and the former CTO of Laureate Universities Australia. Harness Projects are now seeking $2 million to fund our growth plans and realize our vision of bridging the gap between education and employment in an AI era. Key roles will include investments in technology, sales, business development, and product. We have fully modeled our existing unit model and target goals for the next 5 years as we hire our key talent and scale our model across the US and Australia and beyond. Our growth flywheel and dual revenue streams make this a really attractive opportunity for the right investor. So if you would like to get in touch, please get in touch with me on LinkedIn or CapitalHQ to view our deal room, and I can take you through this in more detail. Look forward to chatting. Thanks a lot.
Good afternoon. Good morning still. Things move fast in our business. Thank you for having me here today. Just as a matter of interest, I'm very thankful for that because it was just 3 months ago that I had a quintuple bypass. I've got the scars to prove it. And that showed me very much how fragile life can be, particularly when it involves your heart. And we've developed a product that will fit into the emergency response for people with sudden cardiac arrest. I'm just going to show you a quick video that will give you a bit of an overview of our business.
Thousands of home defibrillators are being rolled out in Australian homes with hopes that one day every household will have one. They weigh less than 0.5 kilogram. They're easy to use if anyone suddenly collapses.
David Whiting is getting back to doing what he loves after suffering from a sudden cardiac arrest.
Something I hadn't experienced before. At some point, I just collapsed.
Every year in Australia, around 25,000 people go into sudden cardiac arrest. 80% of those happen at home, but less than 3% survive.
Sudden cardiac arrest is sudden, instant, surprising. You need something immediate because after 10 minutes, it's virtually impossible to bring you back.
You can now purchase a miniature AED, a key life-saving device, to keep at home.
Having one in the home where the majority of sudden cardiac arrests occur goes a long way to narrowing that survival gap.
Survival for people like David, who was resuscitated by an off-duty lifeguard and an AED.
The number one factor that helped my survival and recovery was early intervention.
Designed with instructions for both adults and children, it costs around $360.
You need to make it affordable to get into the homes. If it's too expensive, it just won't be bought.
It's hoped that by having an AED just like this one in every single home in Australia, within 5 years, tens of thousands of lives could be saved.
It's going to be peace of mind that hopefully you never have to use it, but you have something at hand that is literally can save someone's life.
Nick Hose, 7 News.
Thanks. So the company has dedicated itself to saving 100,000 lives by 2030. That's a goal of the business. And just to give you some colour on how prevalent cardiac arrest is, it is larger. The impact is larger than the top 5 cancers combined. It's 16 times more fatal than traffic accidents. It's 300 times more fatal than house fires. And cell aid can be as ubiquitous as smoke alarms. For those who have already met us in the exhibition hall previously, we do ask people a question if they know where the AED is in this building. And minutes matter to helping somebody in a cardiac arrest. I can carry this anywhere. I take it overseas with me. It goes in my carry-on baggage in an aircraft. And I literally take it to dinner with me. My wife puts it in her purse. It would be very tragic if head of investor relations of a company like ours wasn't prepared in that situation. So we're always prepared. And one thing to show you the ease of use, we have a training device and application is as simple as snap, peel, stick. And then it will go through all of the audible prompts, coaching the bystander through delivering what we hope to be life-saving care before the emergency services arrive. Sadly, in this room, there's going to be 40 people in the next 12 months that are going to experience directly sudden cardiac arrest or have a loved one or member of their community suffer cardiac arrest. In the first minute of application of care, your survival is about 94%. But over the following 10 minutes, your chances of survival diminish. And we are currently in the developed world at a point where only less than 10% of people who suffer cardiac arrest are surviving. And one of the biggest barriers to that is the majority of these events occur in people's homes. Our founder experienced that himself when his partner had a cardiac arrest. After she survived, he went and looked at protecting his family with an AED. What he found was expensive technology, portability was low. Sure, if it's in your house, that is great, but we don't spend a lot of our lives sitting at home. And it needed to be affordable, as he said in that video, otherwise people will take the risk and forget about it or minimise it because the cost of mediation is high. We all insure our cars, we all insure our homes. This insures your life. We are the world's first personal AED. There was no point in making it a little bit better. We had to strive for the best AED available in the world. And technology and regulatory is a significant hurdle for that innovation. But our device is 75 to 80% lighter than a traditional AED, 70 to 80% smaller in form factor, and we've reduced the cost and maintenance of devices significantly. Not only does it do its job as a device in an emergency situation, but we can manage that relationship with the customer through IoT connectivity cellular. It will report to us on a monthly basis. It will report to us the incidents and the information that's collected during those incidences, so we can continue to build a better outcome for patients going forward. We've currently sold over 22,000 devices since we've been delivering to customers over the last 2 years. We are the number one selling AED in Australia. We are outselling traditional brands by about 8 times. So we have identified a market that didn't exist, and customers are now coming to us directly and through channel partners to purchase AEDs to protect their families and communities. We are selling across 7 countries at the moment, and the majority of our customers are taking up a membership, which creates an ongoing relationship with that customer and a very big support to our business model. The addressable market is huge. I don't like the big numbers because they make people's eyes roll in their heads. But for instance, in New South Wales, there's 230,000 nurses. They leave their office or they leave their hospital every day with a massive amount of skill and a massive amount of desire to help people in their communities. What they're lacking is a tool. First responder networks like Good Sam or PulsePoint in the US or Suave Life in France, people are dedicating their time to be on alert when these instances occur. Now they can have the tool in their go bag or on their fridge door, available for their own family, but also in the community sense. There's millions of police officers. Then there's schools, government buildings, all the places that you see these devices. But building a network, there is a huge market for our products and to improve people's lives going forward. So the subscription model, we sell the device for $600 up front. We include the membership free for the first 12 months, so we can invite somebody into that ecosystem to learn the benefits that they get from having a cell aid in their family. We will replace the device if it's used. We replace it when it reaches the end of its life. So we've taken that management and maintenance worry away from customers. We have the remote monitoring. We collect all of the data during events. And one of the questions that we get a lot is, can it be copied? Obviously, certain countries around the world have reputations. Medical devices are very difficult to copy. And even if you do copy one, the provenance of a medical device is important to the end customer. Sure, you can go and buy a $1,000 Rolex that's a copy, and nobody will be the wiser. But if you're buying a medical device by somebody who hasn't gone through the regulatory processes and the technical processes to prove that the medical device is going to do what it says it does, it's going to break down. So we are Class 3 medical device. We interface with multiple regulators across the world. We have thousands and thousands of compliance documentation, and they're literally one regulator or notarized body is in our offices conducting surveillance audits all of the time. We've protected our business with patents, design registrations, trademarks across the globe. So we've patented the activation sequence. We've patented the therapy within the device, which is known as a waveform, so that electrical discharge. We've patented the way the device delivers that discharge through capacitors and through the battery technology. So we think we've got about a 5-year head start on the rest of the marketplace, and we already have a pipeline of additional product-specific AEDs, such as the medical market or a military market, so that we can continue to build our business and stay ahead of the competition. So we're in the market at the moment, raising 15 million Aussie in a pre-IPO convertible note issue. We've got commitments of over 9 million. It's currently open, so come and see us for more details, and we're happy to have a conversation more about our business. We want to build a foundation for global and US growth going forward, so that we can service our goal of saving 100,000 lives by 2030 on a global basis. Thank you very much for your time.
Good morning, everybody. Paul Millard's my name. I'm the co-founder and the CEO of Invertigrow. I guess first question, and make sure everyone's awake this morning. hands up or give me an indication of those that have heard of indoor vertical farming as a thing. Okay, keep your hands up if you've actually been to one and seen one in operation. Okay, there's a few of you. It's a new space. It's emerging rapidly. It's an exciting one. I guess the question is why? Why is it exciting? Globally, we're facing a bunch of issues with urbanising populations approaching 9 billion. That's driving the need for us to generate 70% more food by 2050 to feed this population with changing diets. Soils are being depleted and degraded at an alarming rate. We've got water scarcity as a major concern, and our resources becoming increasingly depleted globally. Erratic weather and changing climate are increasing the actual instances of weather-driven disasters as well, and they impact our ability to produce food. And increasingly lengthy supply chains are driving consumption of more resources, but also food waste, packaging, and all impacting our ability to feed the planet. So we simply must find smarter ways to feed ourselves. Indoor vertical farming is part of the answer. It's not going to answer everything, but it must be part of our food system globally. Reliably growing crops year-round, independent of weather extremes, with a fraction of the land used. We use less than 5% of the water of traditional agriculture. And with access to renewable power, we can get very close to a zero carbon footprint growing this way. So what this enables us to do is to build farms everywhere at any scale with greater food security, fewer food miles, and reducing waste and packaging. Ultimately, sustainably allowing us to grow what we need when and where we need it. The challenge, however, has been to date that indoor vertical farming is complex and it's capital intensive. It's also been high OPEX to operate the farms. And this has led to commercial challenges with viability for many of the farms across the planet that have pioneered in this space. What Invertigrow is doing is solving these problems. We're emerging as a winner on the global stage by bringing solutions that drive and enable profitability in this space. 4 key uniques to our business that we really focus heavily on. Firstly is the affordability of the farm and its ability to produce food at an affordable, cost-effective level to be able to make money, which is key. Secondly is scalability. And what you'll see is the way we've designed our farm in a modular way, you can build and scale to suit the needs. You can build a small farm and scale from any size up to a mega farm, and I'll explain how that works. The third is around flexibility, crop flexibility, to grow anything that can grow indoors, and that's key to our design as well. And finally, smart, that it is plug and play out of the box. We don't have to, our customers don't have to worry about the 200,000 hours of engineering and R&D that we've done to build our product. They can plug it in and start growing. That reduces the OPEX cost for highly expensive labour to run these farms, and it means that ultimately we can help build profitable and commercially viable farms anywhere. Our technology, our solution involves the hardware, which you can come and talk to us about, which is the growing unit itself, the software to run it on a SaaS subscription model, services from design the farm, build it, to ongoing farming as a service if our customers wish, and supply of the inputs, the grow media, nutrients, seeds. So there's a number of annuity streams to our business, as well as the upfront capital for the farm itself. The products that we've built and patented are unique across the planet. We have an inverter cube, which is effectively a farm in a box, and that unit is our commercial workhorse. Can be scaled from one unit you've got there to any number in a facility. The second is our inverter wall, which some of you may have seen in store in Woolworths. This is in Park, Sydney. We were running a pilot with them for about 18 months. So an in-store, in-restaurant, in aged care facility, in school, so we can have a farm literally anywhere at the point of consumption. Now these two combine to give us the ability to build really unique, highly efficient supply chains with a hub farm growing the produce, and then the produce displayed, still growing for the consumer, the chef, the bartender, the school kids at the point of sale or point of consumption. Competitiveness, affordability is key to our business, and that's how we win. We've been benchmarked against the best on the planet, and we're in the magic quadrant, that top right corner there, which is demonstrating both capital and OPEX efficiency against literally the best companies on the planet. This is part of a tender that was conducted at NEOM in Saudi Arabia with an independent assessment here. So we're in a great position to win, and we are winning on the world stage. Now, scalability is key. I'll talk about that in a minute, but flexibility around how the product actually works. You can see we can easily configure different crops with just minor changes in the way that we actually set out the farm itself, from microgreens, baby leaf, a whole range of different crops. So by having it easily configurable, we've grown 400, 500 different crops to date, from leafy greens to berries, edible and ornamental flowers, medicinal crops, microgreens, even exotic mushrooms. We can grow fodder and an increasing range of seedlings, which is pretty exciting. We can grow crops that can actually go out into other farming applications as well. We don't have to do it end to end. And this opens up a very interesting and massive market for us. So pretty much anywhere along the food value chain, we can build a farm to suit the needs or where there are disruptions or problems. Now, what that means commercially at any scale, and the scalability piece, from micro, this is a farm up in Cairns for research purposes with 2 cubes, up to, like Lego, any scale. That's our other farm in Sydney here as our MVP. And you can see the way the cubes actually move as a pallet, but we can build a farm into pallet racking at any scale. Now, the big market is a blessing, but also a curse. Where do you start? So we've actually zeroed in on a sweet spot to begin with, which is key market segments, as well as key crop types and key geographies. We have a $50 billion market conservatively, global scale, and we intend to go after that full market in time. Traction globally. We've got our first customers operational in Australia, multiple farms around the country. We've entered the GCC and have our first farm operational in NEOM, the biggest giga project on the planet. We're the first indoor vertical farm to be awarded a contract there, and we're actually up and running. That will be our growth engine as a business, the Middle East, the Gulf. We've got our first farm operational in the UK as well, and we're growing our UK and European markets next, and then we'll follow that with the US and Canada. We've got certain pilot projects already virtually done with those in Canada, and we look to expand that market as well. So traction building. Revenues. We are first year of I guess real revenue. Last year, 1.3 million Australian dollars. This year, financial year FY25, we should do 5 million Aussie. Now that's 7 million of contracted revenue, and that will be an LTV of over 24 million over over the next 10 years, and the pipeline growing. So pretty exciting. Sorry, what's happened here? I've been asked to change password here. I'm not sure why that is. Excuse me. Okay, very proud of some awards that we've been winning both locally and globally. The trophy cabinet is filling up. Increasingly and interestingly, it's not just for innovation, but also for our ability to influence and impact supply chain resilience and sustainability. So the opportunity that I'd like to share with you today, and please come and see me to discuss, come and join our exciting journey. We're an Australian company. We're going on an amazing journey. We're a fair way down the path, but we're really starting to come out of the blocks. We've built and commercialised an amazing product that will revolutionise indoor farming and supply chains globally. We've got substantial revenues, both banked and won, and a healthy and growing pipeline. We've successfully progressed through our angel, seed, and our Series A capital raise, and we're preparing for our Series B next year. What we're offering is a pre-Series B opportunity to invest with a safe note. It's a discounted safe. It will convert to ordinary shares upon the close of Series B or 2 years. There's discount off our current valuation based on and commensurate with the size of the ticket. Minimum investment of 100K, And we're raising up to $4 million, of which we've secured 650 to date for this round. Please come and see me. We're out on the booth outside, and I'd love to chat with you guys and share the opportunity. Thank you. There's a QR code there too if you want to quickly take a photo of that. Thank you.
I was approached by the two directors and guiding lights of the company, Matt Dixon and George Gregan. And frankly, I was immediately intrigued. First of all, I was intrigued by them because they have a high energy and that's always attractive. But I've always been a lifelong person committed to fitness. I ran the North Face for 20 years, and you couldn't do the hiking, the skiing, the climbing if you weren't fit. Frankly, what I saw was a tremendous number of parallels between PTP and their desire. They want to move into apparel. Bahi, I knew I could give them some good contacts, good advice in that area. And I had some super contacts in the UK, Kim Windsor, who we worked with on a number of projects together. And she said she'd join in. And so I knew I could contribute a lot. And I knew I wanted to be part of it because of the parallels that I saw out there. The reality is I liked him enough that I ended up being a part owner and also being on the board and advising them. That being said, the parallels that I saw and that I see to this day are the first one is the people. People always make the difference in a company. And what you need in a sport company, I believe, is where the owners actually use the product. They aren't shills for business, they use the product. Quintessentially, nobody could be more committed to fitness than George Gregan, and Matt is of the same way. And at the North Face, we use those people. We call them trendsetters. People call them athletes, but the idea is you make the right decisions regarding products and processes and whatever if you have the right people at the top of the company. The second thing was they want to develop an iconic brand. And that's what we always wanted to do at North Face. That's what I did. And I know how to do that. I know how to add that value. So when I talked with Matt and George, they were intrigued about letting me contribute something. I also see that what is affecting the whole world are kind of two mega trends: globalization and democratization. Globalization being move everywhere. Well, that's a commitment they have, as we did at North Face. Wanted to be a global company. It doesn't happen overnight. It requires processes and procedures to be able to accomplish it. Democratization basically is putting things in the hands of the users. As opposed to having somebody just go to a gym, what they do is provide tools for people to work out wherever they are to be able to advance their health. That, to me, is the direction we're going to go there. The key of them wanting to build a great company, the best company, not just another company, not just a better company, but the best company, resonated with the way we always did it at North Face and what we wanted to do. The bottom line really is that it's great people, it's great products, and it's a desire to be the best. That's what I wanted to be involved with, and they gave me a chance to do that.
Thank you. I'm Matt Dixon. I'm the founder and CEO of Fitness Systems United. We've made up of three brands. PTP, which is our performance fitness brand. I'm just going to try and move that forward. Which is our performance fitness brand. And Bahi, which is our yoga and Pilates brand. And then MediFit is a mass market approach to going via pharmacy, a similar branding to PTP, but targeted more at the active aging demographic. Just to jump into each one of those brands a little more, PTP, we're very much aligned with the strength and conditioning coaches and physiotherapists from some of the biggest sports, the most elite sports teams in the country: basketball, the Boomers, Rugby Australia, Netball Australia, Basketball Australia, Football Australia. So we do the Matildas and the Socceroos as well. So we get a hell of a lot of ideas and thoughts and feedback from those professional organisations. But we're making the products available to all. Key channels, obviously into sporting goods retail, but gymnasiums, personal trainers, and obviously direct-to-consumer. Direct-to-consumer now only delivers about 1% of our revenue, believe it or not, yet it's the most perfect product for that. Small, portable, durable, non-seasonal, easy to ship. So we're very excited about that opportunity. The company's been bankrolled today by George and I personally, and we're now really just we're at a bit of a different stage to some of the other businesses you're looking at today, and we're really keen to supercharge and realise the opportunity we've got in front of us. The demographics are a little more male oriented with PTP, and the primary consumer groups between 18 and 34. We know all this through our online sales. As we went around the world and grew the business, we started to see that multi-branded sporting goods retailers, but also multi-branded retailers, for example, Harrods, who we launched Bahi with only a month ago, really lacked a yoga and Pilates brand that delivered all the products like a Lululemon does. They don't have the option to sell that kind of product. So we were originally going to be Flow by PTP, and then we decided to call it Bahi, which is rooted in the origins of yoga from 5,000 years ago. Bahi means flow in Hindi. We've also developed through Kim Windsor the apparel range, and that was what got us into we're getting into John Lewis in the UK as well. So it's truly going global, and studios, sporting goods retail, department stores, and fashion boutiques are all primary suspects for us. And then MediFit is a much smaller range of products, all around strengthening, targeting the active aging demographic via pharmacies where there's a huge number of door counts. So we've just got into CVS pharmacies in the US. They've got 9,500 stores. We're in 260 of them right now. So the opportunity there, we've just pitched also to put some external pain management products in through PTP. And it's targeted at 55 and over demographic. George Gregan, my business partner, I think most of you would probably know who he is. He's former world record holder, rugby world champion. He's the athletic director for the business, extremely passionate about physical activity and movement for a better life. Hap, who's come on board, who you saw the video of, and Kim, who's got an OBE from the Queen for services to British fashion. We've got a great team, very high calibre, positioned in California, London, and Australia. This is what we've built over the last 10 years. The Lime countries are where we operate, and the list of the retailers that we're in are listed there, but we're in over 40 countries, and we've done that pretty much from Australia. Hence the reason we're here today, looking for a smart investor who loves the brand, loves physical activity and wellness for a better life. So, we've got the other thing we've done is we've opened a number of doors. So Dick's Sporting Goods in the US, and I'll talk about why this is our growth model is both a mix of wholesale, direct-to-consumer e-commerce as well as brand growth. So for PTP, we've got a number of big accounts opening up. We've got Costco in Canada, which will then blend into the US. We're rolling out into CVS pharmacies. We've just onboarded with Dick's Sporting Goods and Dunham's. And then with Bahi, we've got a number of new accounts that we're opening up as well as Boots in the UK for MediFit. So, we've done a lot of hard work opening all of these up, and where we see the three big growth opportunities is the first one is in replicating the success that we've had in a couple of accounts, one of those being Rebel Sports in Australia. We know that if we can grow 3 accounts, half the size of Rebel will be a $30 million business within a couple of years' time. We're currently a $13 million business. We've made money every year. Last year was a tough year for us, but every other time we've made money. We know how to make money in this business. What we just need is the right sort of growth capital to go and grow these brands and really realise the opportunity out there. The second one is to grow the brands, and that is through alignment with the professional sports, and we are looking to sign up ambassadors by sport. We've released our training app. We're going to have training-specific programs through very high-profile athletes in NFL, rugby, netball, basketball, etc. There'll be a bit of a revenue share play there, so there's not going to be a huge amount to pay up front. We've had a lot of conversations, and obviously George and Hap and people like that have really resonate with some of these people, particularly these athletes who are still athletes but thinking about what they're going to do after their careers as well, and that's how George came into the business with us. And then the other one is the digital platform. So there's a big play around that to increase our margins, but also as we bring these ambassadors and high-profile celebrities into the business, we'll naturally get a lot of cut through from a marketing perspective as well. So the Rebel model, we're in every store in Australia. We've got a 5-year locked-in deal with them. We're 2.5 years into that deal. It's got minimum purchase commitments. You can see we went from 7.7 to 8.4, and it'll be 9 million this year. And so as a $13 million business, that actually represents quite a high proportion of it. But 2 years ago, it was actually the other way around. It's just that the international business has slowed down, and while our customers sell through their inventory from the COVID explosion. But we are also in their strategic brands, so we're very proud to be put up there with the Nikes and the Adidases and invited into the tent. We actually co-develop products with the Rebel team, and we are able to sell those globally. So it's a very, very healthy relationship, and one that we think we can replicate very quickly with the right use of investment funds. So in terms of digital growth, so we've got our e-commerce platforms. We've got 7 sites up and running now, in 2 in the UK, Bahi and PTP. We've got PTP Canada, US, and we've got PTP, Bahi, and MediFit in Australia. They're all integrated with our Oracle NetSuite platform. We've got all our subsidiaries set up. So we've actually got PTP Fitness Canada, Fitness Systems United Inc., USA Inc., and also in the UK Limited as well. So we've got a number of them. We launched our fitness training app this year, and it was just really a test to provide our customers, our consumers, because we don't know what they do with our products after they buy them, and neither do our retail partners. Now we know. We know how old they are, how often they're engaging with the app. We know what sort of intensity of workouts they like, what products they love. And this is all being shared back with the retailers, and we're the first brand that's actually doing it as a commission, recurring revenue commission for our retailers, which is really protecting our shelf space in the stores and deepening the engagement we're having with these retailers, because we can share that data. So we've had 18,000 accounts already set up without any marketing expenditure at all. So I think it's working. And the other thing is we can start to see now, because there are Japanese character sets coming in. So we've got Japanese people joining. We've got people in French character sets as well, French wording as well. So with the app that we've developed automatically converts into Japanese, French, or English. At this stage, we're using AI to do it, and we're using AI voices as an overlay into those workouts. So we see and then obviously the other one will be through socials with these ambassadors that we line up with. So in terms of how we're going to grow, leverage the existing global customer base. It takes 12 months to onboard with some of these customers, but once you onboard with them, you get a customer like Rebel. It's $9 million a year. It's for $60,000 per store per year. So we've done the hard work. We've got it to there. We now need to invest to really light that up. The software app, so recurring revenue and customer retention. We know more about those customers, as I just explained. We've got this growing database from around the world that we can take advantage of, as well as we'll be tapping into the organisations that we're already sponsors of, like the Swans and Carlton and Rugby Australia, etc. Okay, and then 3 subsidiaries in the UK. So massive markets. I don't need to explain. They're in the hundreds of billions of dollars in every one of the areas that we play. In terms of how we're looking for $5 million. It's for an investment. It's investment capital. We're not looking for debt. And pretty much 50% of that would be spent on sales and marketing over the first 2 years, and about 25% of that would be on operations and executive and finance. A bit of development in the tech part of the business, as well as the apparel, which we've already launched. And that's the growth trajectory that we're looking to achieve. This is all available, guys. You can come and talk to me anytime you're ready. And then they've just, at the back of that, there's a bunch of examples of us being ranged in different parts of the world. So Sports Experts in Quebec and Canada, that's Atmosphere in the Quebec. This is Tokyo, Zabio in Tokyo. So we've done the hard work. We're just looking to get a great partner in to help us drive this forward. So thanks very much, and look forward to speaking to you guys again.
Hi, my name is David Hayes. I'm the founder of BabbleText. BabbleText is going to reinvent your customer service. So the basic principle about BabbleText is all about taking your customer service from voice to messaging. We do messaging like your customers do. Think about that for a second. You can chat with your customers through their preferred messaging app, rather than being confused on a voice call, which is highly inefficient. So if you engage your customers on messaging, you're also, through BabbleText, engaging your customers in their language on their device. How does BabbleText work? It's really simple. A consumer can message in Mandarin, That message will come into the platform. It'll be automatically presented to a live operator in English. That live operator will then respond in English, and that response will automatically then go back to that consumer's messaging in Mandarin. And we do that for 135 languages. So today, customers want to be able to message rather than speak on calls. So we empower your business from all sectors to engage globally with their communities in 135 languages using their customers' preferred communication and social channels. That's a really important thing to understand, because messaging is not just SMS. It's web chat, it's Facebook Messenger, it's WhatsApp, it's WeChat. All of those messaging platforms are integrated with BabbleText. So the basic stat is 64% of customers preferred text rather for their customer service. So let me give you some basic facts. Voice is $1.50 per minute, and it forces real-time participation. Significant time is invested not only with the live operator, the customer service agent, but also the consumer. And the first contact resolution is about 76%. And there's also that potential for miscommunication, and it's mostly English. Whereas with text, it's around about 9 cents to 15 cents per minute. The consumer responds when it's convenient to them. There's no time pressure. First contact resolution is about 80%. And you have that conversation history in all of the languages, and of course in 135 languages. So why BabbleText? Very simple. It's unparalleled engagement. It communicates in 135 languages. You can integrate BabbleText into your existing ecosystem. It's simple and intuitive for the customer service agent. You foolproof your customer service by understanding what they really want by having that entire history of that conversation. And of course, we customize and white label for you. So, as I said before, how does it work? Messaging is not only SMS, it's WhatsApp, Google Business Messenger, Facebook Messenger, web chat, Discord, SMS, Telegram, WeChat. So with BabbleText, you can have a situation where a consumer can start their conversation on SMS, and then they can go to Facebook Messenger, or they may want to go to Discord, but it'll all be presented within the customer service agent's web interface in one conversation history. So one conversation history within the operator interface, regardless of what channel they use. So BabbleText is efficient, cost-effective, multilingual, and secure. We are an AWS partner, we're an AWS qualified software partner, and we're an AWS public sector partner. So this is the fundamental architecture of BabbleText, with the various channels, the conversation channels being WeChat, web chat, SMS, Facebook Messenger. By the way, we are the only multilingual web chat in the marketplace. So again, the consumer text in their language, it goes through XConnect to validate their mobile number. It goes through the messaging pillar, the translation pillar, and the dashboard, and then presented in English to the customer service agent. The customer service agent then responds, and that customer service agent in English will be automatically translated back into the language of the consumer. So what we're doing is we're providing you the opportunity to engage in your customers in their language and on their device. Now, BabbleText has also got tabled for Q4 this year to be able to provide the platform not only in English for the operator, but Vietnamese, Punjabi, and in Filipino, to provide the opportunity to use the platform with operators from various parts of the world. So where's the product fit for BabbleText? Healthcare, of course, dealing with cultural and language diverse patients. Government, when they have maybe a council where high non-English constituents. Hospitality, well, that's obvious. You have non-English speaking guests. Corporate, globalize your customer service. Help services. Mystery Shopping told us that there is no help service in Australia that supports a language cultural language diverse community. Education providers, student communication, overseas students, immigration, that's of course. And of course, crypto, that is a massive market using Discord and Telegram platforms. So how do you take your voice customer service and migrate it to messaging? It's very simple. Use devices such as the QR codes. So you fundamentally have QR codes on your website or on your marketing material. The consumers just simply scan the language of their choice. It'll open up the SMS on their mobile phone. It'll pre-populate it with a number and pre-populate it with a message in language. They then just scan, click and send, and they're automatically communicating in their language with your customer service operator. So the key statistics, it's a preference for customers, texting, customer satisfaction. Well, we all know about customer satisfaction scores. Cost saving is considerable cost saving for both business, and the most important is efficient for the operators. And there's a massive demand in messaging with messaging apps across the globe. So our solution is very simple. It's one interface, it's scalable, it's a SaaS platform. There's cost savings with customer service agents being able to manage multiple conversations, and customer presentations are never lost. You can target the audience because messaging is ubiquitous. And demand, well, SMS, web chat, WhatsApp, Telegram, they're all able to be used in 135 languages. Now, when it comes to translation, the BabbleText platform had a positive independent review carried out by the Ethnic Community Council of New South Wales, where they endorsed BabbleText to say if you wanted to engage with the cultural and language diverse community, BabbleText is the platform to use. So when you migrate to messaging, what do you have to do is you have to advise your customers. So we have a message broadcast platform as well. So you can load your customer database in, broadcast a message out to your customers. They'll respond. You have that live operator conversation. There is a positive outcome. You can then retarget them and create that conversational marketing opportunity. Teams, well, talking with teams, let me give you a typical example. We've got 15 builders out there in the marketplace who are running around doing odd jobs. How do they communicate with a central location? How do you keep a complete history of all those conversations and they have a central source of truth? BabbleText is a perfect application for your team. So we have two platforms, which is one is the multilingual customer service platform, one is MessagePort. One provides that conversation in 135 languages. It's scalable, it's omni-channel. You can export all the data, you can integrate with your existing CRMs. The MessagePort is our broadcast platform, which enables you to broadcast message to all of your customers. You can have personalized message, mass sends, alerts, multilingual broadcast, and you can also integrate with Microsoft 365 and many other applications. Sentiment analysis, this is the big opportunity moving forward. When you have a conversation history, you are able to analyze that conversation history and you're able to understand the sentiment of that consumer. This is the great opportunity that AI provides to BabbleText. And we are working with AWS to build a AI generative sentiment analysis platform that'll be integrated within our dashboard. So you as a manager will be able to analyze that conversation and pick up the true sentiment and trends on all of the conversations that are generated within your conversational marketing. BabbleText and AI, this is the new buzzword, but more importantly for BabbleText, it's all about analyzing the conversations, not creating the conversations. We're not an AI bot. We use live operators, and of course those live operators generate conversation. But when you're able to analyze that conversation and analyze the language, know the mobile number, analyze the social media conversations, and with the large language models, we are able to get and really to the core of that conversation and restore a measure of surprise and delight in that customer experience. Predict and prevent. Relevance means revenue. Our team is a good, solid team with myself. We've got some strategists. We've got a good tech lead, good tech team. We've got a couple of marketing people. Our CEO's been there since day one. We've got a good UI UX team. We've got a strategist over in France to help us with global penetration. We've got some good legal and accounting partners, and with our R&D is all managed by Deloitte. So that is BabelText. We hope that you have enjoyed the presentation. Please, if you have any questions on the platform, please don't hesitate to reach out. And let me finish by saying your customer's message to you, future-proof your customer service. Thank you for your time.
Hi, everyone. I'm Adam Good. I'm the founder and CEO of Auric Essentials, a company poised to revolutionize how you think about wellness technology. So in today's hyper-connected world, balancing life and balancing your life in this environment is extremely difficult. Those various different mood states you need to jump between being focused, being energized, having a good night's sleep. Even the most health-conscious individual struggles with this constant ability to do this. Now, we've got visual aids like Netflix to help us relax, or music to do the same thing, but one of our most primal senses is very, very much under-indexed, and that's the power of smell. Now, aromas, especially those from nature, can profoundly impact our well-being. We know that the ability to regulate our moods, they solicit memories, and they provide emotional responses. And this is what we're doing at Auric. We're building and introducing the Auric Aromasphere. It is a beautifully designed, highly personalised IoT platform that blends the evocative power of scent with cutting-edge data-driven technology. I want you to imagine the elegance of ESO, the functionality of a product like Sonus, and the simplicity of Nespresso all brought together in one device. Now, what the Aromasphere does, it's equipped with 8 TGA-approved essential oils, and they're uniquely created to blend these rituals together. Now, the rituals are from scientific research to help with sleep, with energy, to help with anxiety, and they support these distinct mood states that we require, such as sleep, focus, relaxation. And the Aromasphere really gets rid of those key friction points with the aromatherapy industry. They're messy to blend. You're not quite sure what oils to use at what particular times, and it's certainly very low-tech and not connected. And this is what sets us apart. We've got this Auric Wellness Signature. It's an algorithm that adapts in real time. It takes data sources from your calendar, from weather conditions, also biometrics such as Apple Health, Google Health, and combines that with the combination of your health questionnaires to actually deliver these bespoke rituals delivered at points in time. So if you think of Auric, it is really a mood as a service. If you and it can be the centerpiece of your daily habits. It's for the bedroom or the home office or the living room. So imagine at night time you're preparing for bed or thinking about it. The Auric Aromasphere will deliver a sleep ritual at that point in time. It's connected to other IoT devices in the home, so the lights dim, music can play. You might get a dash of lavender, peppermint, and bergamot. And through this sort of Pavlov's dog sort of theory, you will actually be triggered to get ready for sleep. So the growth drivers in this area is really the wellness industry. It's growing at a very large clip. It's about $4 trillion industry. We've got wearables now at over a billion users of wearables. And this convergence of your home IT, IoT technology in the home is also growing. But really, scent as a product category hasn't really been tapped into at the moment. So this idea of connected aromas for their therapeutic mood enhancement is an area of growth. What we're tapping into is sort of the convergence of three markets: the $1 trillion IoT market, the aromatherapy industry is growing at $13 billion, and then they've got the wearable wellness tech industry. And we see a TAM of $1 billion, and we're focused in on a 5-year plan of a sum of $100 million. It's a hardware recurring business model. So the device is at $299, which comes with the 8 therapeutic oils. And then from there, you go on to repeat purchases, which are high margin business of essential oils. You can buy one oil at a time, like you might do with a Scent Foundry subscription, or we're moving people towards more of the subscription-based model. The founders, myself, I built a hardware recurring business model at Telstra some 12 years ago when streaming television was at its infancy. So we know about finding the right audience and the right product market fit. Alex is a robotics engineer, and we've also got a pretty incredible product team, including Eric Aldrin's part of the Meta team that's been doing the HoloLens work, as well as biometric experts, and Robbie Wells, an industrial designer from Breville. So competitive state, we're really, the aromatherapy industry and the essential oils with companies like Del Toro, Young Living. You've got your wearable sort of partnerships as well. We're more into this highly personalised, multi-sensory experience, working with the Google ecosystems and the Apple ecosystems, Philips Lighting, those type of products. Traction-wise, we've already had 45,000 in sales. We've got about 1,500 people in a wait list. We've recently been funded by Antler. We've been in this residency program downstairs building this product out. Our manufacturing, our trademarks are all secured. And we've also secured a major media partnership with The Block. The Block next year, we love that show, 1.8 million, 2 million users. They're doing a wellness season next year in Dalesford, Victoria. So 2 of the contestants will be wired up with the Aromasphere. That's a very large audience, 1.8, 2.6 million people. That'll really show what this product is all about, working alongside sort of new technology. We are the Australian Startup of the Year. Next week, we're off to represent Australia at the Entrepreneur World Cup in the Middle East and Saudi Arabia with our product. So thank you very much for the time. What the ask really is, we're halfway there of our $500,000 seed round. We are early stage, but we will have 3,000 units out on the Scent Cloud this time next year. So we take check sizes anywhere from $25,000 upwards. We close this out in the next couple of months. So that's Auric. We're at the forefront of personalised scent technology. Thank you very much for your time.
Hi, my name is Frances MacDonald and I'm a founder and director at Capstone Income Fund. Capstone Income Fund is an Australian real estate debt fund, and real estate debt is a great asset to add to your portfolio because it offers double-digit returns, it has less volatility than equities, greater yield than fixed income, and overall is a great diversification strategy for your investment portfolio. Let me get into who we are and what we do. I'll skip over the T's and C's and go into what is this opportunity that's available. And there's a unique opportunity for non-bank lenders in the market to generate outsized returns. And that's because traditional banks have retreated from certain segments of the market that has allowed non-bank lenders to come in and realise returns at a premium to those received by banks in underserved parts of the market. And also borrowers in some segments really favour non-bank lenders for their speed and their flexibility. On the investor side, private credit has been the alternative asset class of 2023. In the period we've had of volatility, inflation and macroeconomic uncertainty, private credit has been very attractive as a yield strategy and diversification source. At Capstone Income Fund, our fundamental strategy is to deliver outsized returns relative to risk to our investors. We do that through investing in a diversified portfolio of registered mortgages. We target higher interest rate short-term loans. Our loans are generally 6 to 12 months in tenor, and that actually minimises our risk profile because it means we are less exposed to longer-term market volatility, and we're generally very aligned with our borrowers on the exit of the loans. The majority of our portfolio is first-ranking security, which means we are first in line to be able to take over an asset to recoup our principal and our interest in if we need to. And we have very strong capital preservation in our fund. Not only do we invest in very deep liquid areas around key cities, but we also have a conservative LVR, which is our loan to value ratio of 60%, meaning there is $100 of value underpinning your investment for every $60 we've lent, giving significant headroom for market fluctuations. Our offer to our investor base is a consistent, high-yield, passive income stream of 10% per annum. We have a very flexible product, giving monthly distributions and no lock-in periods. And a really attractive thing about real estate debt is the level of security underpinning your investment. At Capstone Income Fund, we have multiple lines of defence. We have a conservative LVR backed by real assets. We're primarily first mortgages. We have strong processes in place. We have strong contractual protections, and also management is invested as a first loss investor. That means our capital is at risk before there's any risk to investor capital, offering true skin in the game and another line of defence on your investment. Now let's take a step back and go, why would you invest in real estate debt? Rather than going, for example, direct property investment, which has long been a source of resilience and growth for investors. Investing in a real estate debt fund allows you to get exposure to the property market while minimising the risk and effort. It has greater liquidity and lower upfront costs when compared to if you were to purchase a property directly. Now, the key thing that I find really attractive about real estate debt is, one, it is an asset-backed security. There are real assets underpinning your investment. Second, debt is higher up in the capital stack, and if anything goes wrong, we are repaid first. So you see on the right-hand side, equity takes more of the price volatility, while debt doesn't look to underperform or overperform, but we are repaid first, lowering the risk profile. The third thing that's really important in debt is the loan-to-value ratio, that we always lend to something where there is more value than our loan, so that can give us more headroom for the ups and downs of the market. From a returns perspective, real estate debt is high yield and has less volatility than other asset classes. What you can see on this slide is the most recent term deposit rate of 4.55%. That is quite equivalent to a risk-free rate, and you can see on the right-hand side how that compounds over time. Equities in comparison, here we're looking at the Australian All Ordinaries over the last 5 years, and that's been extremely volatile. We've had recovery in most recent times, but due to the volatile nature of equities, it's always good to balance your portfolio with other assets to act as a shock absorber. Real estate debt and Capstone Income Fund in particular, what we see here is a consistent compounding 10% return. That offers a really stable, reliable, regular income source where you can see how that grows over time, and that's really attractive about real estate debt. Just to give you a little bit more flavour of actually what do we do and what do we invest in. As I've mentioned, we have a diversified portfolio of short tenor loans, generally 6 to 12 months, and some of our key categories are residual stock, bridging loans and land deals. What you can see here is some of the assets that we have invested in. So on the left-hand side, this is a wonderful apartment building in Redcliffe, Queensland. Queensland, as many would know, has had a boom in the property market. In this asset, the developer has finished the construction of an apartment building, and their construction facility has come to an end, and they need a short loan to get them through the sale of the remaining apartments. You'll see in this one, we have a value of 2.6 million, term of 12 months, and an LVR of 66%. This is a great asset for our fund because it's a very low risk profile. In this instance, a number of the apartments were actually already pre-sold. So you've got a really good indicator of value, and the exit's very clear. In the middle, you see a beautiful building in Mosman. This is a bridging loan, 3.6 million of value, a very short term, and a very low LVR. So again, a very clear exit for this loan. On the third category, you see a land deal that we've done in New South Wales for 2.5 million. In this instance, the developer was in between planning approvals, and once they got their DA, they would then refinance to a construction facility. With land deals, we always look to have a lower LVR, given it is a land deal. So that's an example of what we do. Some of the key takeaways about our fund that I want to leave you with is we have a 10% return with very strong risk metrics of 60% portfolio LVR. Over 85% of our portfolio is first registered mortgages. We have a strong track record in place. We've been operating over 5 years as a non-bank lender. We've done nearly 100 loans actually with no capital loss. And we've always met our 10% return in this fund. We are putting our money where our mouth is, and management is invested as a first loss investor, offering another line of defense to your investment and showing that we really stand behind our business model. And we also seek to offer a really flexible product to our investors, meaning there is no lock-in period, and also you get monthly distributions so you can see that return coming into your account every month. We are open to wholesale investors with investments starting from $100,000. I'd love to have a chat with anyone who's interested, so please reach out or come and download our IM. Thank you.
All right, so now I'll get into my actual presentation. And the first thing I'll say is this really simply, is that I think this is one of the best times that I have seen for accessing for the foundations of growth, right? High growth and also high yield investments. And there's a number of things which come about this from a thesis perspective. And I started with a good portion of these at the start of the year, and then it sort of continued to evolve as it's sort of gone throughout. And so when I think about the direction which we're going to be taking things, for me, a lot of this started from a presentation that was hosted by Pep, right, at our event in May 2023, where he talked to me about the private capital marketplace area, or the private capital markets will grow from $13 trillion to $30 trillion from 2023 to 2033, so over a 10-year period. And that was interesting to me. And then I realized that I was thinking about my own business, not wrong, but there was a great adjustment to make to how we were thinking about our own business. But then when I started thinking about everything that was taking place in the markets, I realized that there was a whole bunch of business, technology, and macro trends all leading in the one direction. And the funniest part about it is I suddenly started to get super optimistic, even though in the last 2.5 years, it's been absolutely painful in the innovation space. Like, this is without doubt, for companies that have been raising money, for people that have been, for advisors that have been involved in the space, for investors that have been involved in the space. When we have this conversation in private, most people agree that over the last 15 years, the last 2 years have been some of the most challenging years to be involved in the innovation space. So then all of a sudden, I'm getting super excited about the future, even though you literally could say it's been some of the hardest years in the last 15 years. So what are these actual trends? And the simple ones to highlight from my side, and I said, my brain is very simple, so I like to keep things simple for myself. And the way it sort of played out was these are the 3 key areas which I saw playing a role in markets over the next 10 years. And by the way, that's sort of typically my personality. I think to myself, okay, where is the direction of where things are headed? And by the way, what was beautiful about all of these is I looked at all of these opportunities and think there's a whole bunch of different players, but everything's fragmented. And to me, that's exactly how we came into this whole innovation space. When we came into the innovation space, there was only a few players, but no one was really taking an ecosystem approach. Everyone was focused on their individual activities that they were doing, right? So the key areas for me that I see as the great opportunity, the Great Succession is probably the biggest opportunity standing in front of us right now, right? For the next 10 years, you are going to see baby boomers looking to sell their businesses, succeed their businesses either to family members or to staff, or just potentially go through a private equity sale, etc. And the reality is about 40% of companies right now are actually owned by baby boomers. So this is, and it was one of my shareholders that outlined it to me, this is the greatest wealth transformation, right? The greatest wealth transfer that we will see in the handover of these businesses. You are talking about the unlocking of trillions of dollars of value in this actual succession space. So for me, you'll see, hence today, a lot of the conversation is around M&A, it's around going to exit. And for us as a company, when it comes November, we're actually going to be soft launching our business sales product as well. Because a lot of people have been utilizing what we do from a capital raising perspective, but the reality is what we've built is perfect for anything that's capital engagement related, whether it be capital raising, debt funding, or M&A opportunities as well. So the expansion of private market opportunities, I'll expand more on that shortly, but yeah, the expansion of that, when you think about all those different areas. Now, what's interesting, I'm doing an article on this at the moment, right, is that it's incredible to know how much how in the last like 10 to 20 years, the amount of companies that are delisting, as well as the lack of new companies that are listing, and especially if you took out, in Australia, if you took out all the resources companies that typically list, it looks even more bleak as far as how many companies are listing. Even though the ASX is one of the most efficient, listing platforms for accessing capital on the way in on an IPO, doing secondary raises, and also, providing, access for investors to participate, it's still been an incredibly tough market because regulation has become more stringent. There's more and more compliance onerous on the CEOs and executives, etc. So now less and less companies are actually looking to list. And in fact, I caught up with an investment banker last week, and they highlighted that they were speaking with a CEO of a $500 million company. And one of the things that they highlighted was that it's too early to be listed at 500 million. Right? They're thinking the ideal range is at $1 billion. And you sit there and think that's what made the ASX, to me, what makes the ASX great is the ability to access the small cap companies. So if it's getting harder and harder for CEOs of $500 million companies, imagine what it's like for CEOs of $50 million market cap companies. So that's why this area of private markets becomes super exciting. But of course, it's not as efficient as what the listed markets are. And then the last one is the rise of non-bank lending and also private credit. Now, I said it's absolutely become a buzzword, but the reality is the infrastructure has been set in place where it is a lot harder for the banks to do some of the lending that's been done. The reason this opportunity is, and this is what's so beautiful about markets in their efficiency and how they operate. When an opportunity becomes available, operators then create products and then they create opportunities for people to participate in those products. And that's how this whole private credit space has become available, is because of where traditional banks have been left off from their actual lending. Now you've got the private operators and fund managers operating in this space. And there's lots of great new products and innovations that are coming out in this area. The next one is the innovation trends. Now, this is an area I'm obviously super passionate about. And so when you hear me talk about the first three, you think, well, does that mean we're not focused on innovation? That is absolutely incorrect. I think right now, and the funniest thing, it's still one of the hardest times to raise money. I think this has to be one of the best times I've ever seen from the investor side for participating in private companies. Number one, valuations are lower than what they were significantly a few years ago. Number two, what companies can do with a lot less money is absolutely phenomenal, right? And the key things I'll talk about, I know it's become hype from a buzzword perspective. The AI revolution is massive. There's no doubting how big it's going to be. When Sundar comes out, when Sundar Pichai comes out and talks about how it's the biggest technological shift in our lifetimes, absolutely believe it. Because not only have we seen what generative AI can do, right now we're seeing the rollout of AI agents. To me, that's just as transformational as what's happened in the last 2 years. I'll give you my own perspective. From us as a company, we did what every other company has gone through in this journey, right? We scaled up in 2020 and 2021. We scaled back in 2022 and 2023. The craziest part is we are now able to match what we were doing 2 years ago and actually go beyond it. And actually, we've increased out what we can do from a capacity and execution perspective with 1/3, nearly 1/4 of what the team members we had previously. That's the story that very few people are talking about, right? Because what you can do from a productivity perspective is absolutely amazing. In fact, there's 3 layers to the power of AI. Yeah, hang on. There we go. 3 layers to the power of AI, right? The first one is productivity. Everyone's experience. By the way, who uses AI on a daily basis? Okay, it's crazy. I'm hoping for the day that everyone's hands go up, because to me, it's like this absolute unfair advantage to have if you are, right? For me, I'll use like 4 to 5 different LLMs in a day just by normal course. Now, the reality is that there's the productivity layer. That's important. Then there's a second part to it that I don't think anyone's really talked about. The more you utilize AI, the more you save on your own cognitive capacity. For most founders, for most business builders, for most people in this space, we've got a million things being thrown at us every single day, right? We will have to make more decisions by 12 p.m. on a Monday than what most people have to make in their week, right? It is crazy how much cognitive capacity that saves us. The third part I discovered with my team last week. The third part that's really interesting is how much it saves team members' own cognitive capacity in dealing with each other. So I'll give you a perfect example of it. Who saw the article that we did on the US presidential elections polls? Who saw that? Surely someone did, because we had a lot of opens and a lot of interest from it. So the interesting thing about that article was that the graphic that was created for it was actually utilized with AI. Now, normally the process of doing that is that you'd have it would go to our head of brand. She would then work with the designer to go and create the graphic for that article. Now it's just a simple prompt and the graphic is done within seconds. So it's saving team members use of each other in the actual process as well. So, to me, that's where I think AI is so powerful in the team perspective. And as AI agents roll out, and I'm running out of time already, the convergence of technology platforms, I think, is a massive one. I won't spend too much time on that. Sorry. And the last one is the era of abundance. And so these are the trends that I'm focused on with AI. AI bots is a sort of starting point. That's been well done over the last sort of 18 months, but I'm still watching what it's doing because I can see more and more how now it's even been rolled out across the execution layer, right? The co-pilot to co-worker, this is exactly what Microsoft took the lead in. Salesforce are talking about it. And it combines with that sort of enterprise AI. The power of enterprise AI means that the need for companies to have the amount of layers of internal redundancy that they did before is just not required anymore, right? AI agents, last week was pretty much AI agents week, which is why we did an article about it on Saturday, right? Anthropic rolled out their computer use, which actually shows the computer working in real time, executing on different tasks across multiple software. If you can imagine what that looks like 2 years from now, and then imagine what each team member's productivity and their capacity inside a company becomes, you start to realize that the potential for the businesses coming forward that are utilizing this tech stack, utilizing these technologies, becomes exponential. And I'd say for every investor, the question I'd be asking to companies that you go into, I know most people want to go for financials, they want to go for all sorts of areas. I'd be asking what's their tech stack they're using, because that will give you a perspective on where their head is thinking about the future. And then last one is Tesla. Tesla absolutely blew me away with what they did with their cyber taxi demonstration, right? They showed so much, and that's what, again, why we did an article about it, right? They literally showed everyone not only what the future of transport looks like, but also how the future product is where the consumer, the buyer of that product, can also turn what they're buying into a money-making opportunity as well. And it's creative how they're actually thinking about it, where they're thinking about someone buys a car, that excess capacity can now be a revenue opportunity for their owner. That becomes creative from a business model perspective. I love this comment because what it means is that future startups you're about to see, they will not need as much money as what they previously would. Every company I speak to at the moment, they're only looking typically to raise between 1 to 2 million, right? There's very few that are saying, I'm looking to raise 5, 10 million, etc. But the reality is because everyone can do so much more with less, and that's exciting. So the impact that we'll see rolled out, firstly, the quiet redundancies will continue. This has just been ongoing. I said this at the start of the year, and it's been ongoing right throughout the year. It still happens today. That in 2023, it was popular to announce about making redundancies and saying that you're investing in AI. that's not as popular anymore. So they're just doing the redundancies, right? And they were even talking about that on the All In podcast, where they were saying, basically, companies are just not hiring like they were before. And the middle managers, supervisors, this is where you're seeing a lot of the redundancies go to. It's the middle managers, the supervisors, the cross-team coordinators, etc., because companies are looking to go for more activity, more direct action between leadership and obviously the workers in the company. And then the last one is the outsourced team members, right? Because if anyone's experienced, either investing into a business or owning a business over the last couple of years, going through redundancy processes, letting team members go, or just general workplace stuff is so a lot more people are actually investing in the outsourcing of team members going forward and then training them with AI, right? So not only getting, cheaper labor, but also incredibly productive labor when given the right training on how to use these tools. So, this is why I say a lot of companies can raise a lot less and do a lot more with that actual money. So for me, I think the explosion of startups you're seeing, but also the explosion of people doing more gig work economy as well, more gig economy work. The reduced need for large fundraising rounds. And the last one is, you're about to start seeing some of the most profitable companies very, very early on because they need a lot less money than what they did beforehand. So the venture capital trends, all these are still in play, still things that we're seeing on a day-to-day basis. This seems to be the core focus for a lot of the companies that we're coming out. And it's all in different ways, whether it be AI, robotics. And by the way, this leads to sort of our next big event that we're doing coming up. Right, but these are still the most common talking points in amongst the ecosystem about what they're focused on from an investment perspective. Obviously, I'm not going to spend too much time on this because I've done a lot of sessions on this, but obviously on the crypto side, whilst it has been going sideways for the last sort of 5 to 6 months, it is expected to go into its banana zone. There's still plenty of money going into the ecosystem, plenty of money being built. And funny enough, what's been really interesting for me is out of the US elections, the biggest winner by far has been crypto, right? Because both of them have agreed to basically look to make their framework and regulatory framework more supportive for Bitcoin and for the crypto ecosystem. So that, and then you combine that with global platform access, the fact that every single one of you can log into your ComSec account and get exposure to Bitcoin and Ethereum, that is powerful. Because if you've ever experienced the process of buying crypto, it's an absolute nightmare as far as accounts being shut down, getting calls from fraud areas in banks. If anyone really understood what the crypto ecosystem had to go through to get to where they are, where overnight they would have banks shutting down their accounts, cutting off their mortgage loans, doing all that sort of shit. That is common for every ecosystem, every business builder in the crypto space. So now, if that framework becomes more positive, watch the money flow. And then this is Cathie Wood's prediction that by 2030, she expects it to go to $3.8 million, which is phenomenal, right? Now, of course, for all the crypto holders, we hope that she's accurate on that. Who knows? It's a bet, it's a play long into the future, but it's done on the assumption that if the big institutional funds just start allocating a portion of their capital to crypto as it becomes more, and when I saw BlackRock do it, State Street do it, etc., mostly BlackRock was the main one. As soon as they saw them moving in that direction, you can see the sort of allocation of capital. Correct, Bitcoin, Ethereum, and also now the push for Solana as well. Correct, 3.8 million is her target for Bitcoin. Yeah. So these are I won't spend too much time on this given I've only got 10 seconds left, but these are some of the areas which have been popular for the actual crypto space. The funniest thing is for me, the real world asset tokenization, we've been seeing those opportunities since 2000. It just for some reason got rebranded this year and suddenly become popular under the acronym RWA. But we've been seeing those opportunities since 2020. The one I don't spend any time on communicating, but a lot of people have made a lot of money is out of the meme coin area. I don't understand it. It's not my area. But I know it's done very well. But all those the one I think super interesting is the decentralized physical infrastructure networks. And I'm doing an article next week where I'll talk about Tesla's play on that, but that's also becoming a high growth area of interest. On the private equity side, once again, you notice it's the common theme that I'm talking about today. These are the trends that we've been seeing in private equity. There is a lot more opportunities for high net worths and family offices to get into private equity products or private equity opportunities now. It's amazing how many investors basically acquire businesses as well. There's people that are coming out of college, instead of doing a startup routine, they're actually looking to acquire traditional businesses as part of it. And this is going to be reflected in what we're talking about today, as far as these are the trends that are coming out in the private equity space. So, it is very exciting. We did an incredible talk at one of our events on the forever acquisition model. It was from Chris Rolls at our Capital 2024 event. But you will see that the private equity area is going to have some significant growth over the next 5 to 7 years. And obviously, us as a company, we want to play an enabling role in that. And to give you a bit of insight we're planning that in July next year, we're going to host a business exit summit, and it will be completely focused around sort of private equity and the exit area. As I said, there just isn't that much content on this space, and that's why I can't wait for the rollout of today's session. This has been common for everyone. Yield absolutely still has everyone's focus. We've done a lot of events on this, but the reality is, this isn't going away anytime soon. And the reason is because Australia's interest rates are not coming down anytime soon. You can see this tussle between the government and the RBA, about what's happening in the markets. But the ultimate reality is, whilst interest rates come down 0.5% in the US, they're now 50-50 on if they're going to continue coming down or if they might need to just leave it or potentially increase them again. But in Australia, we all know that interest rates are not coming down anytime soon. So hence why, going where I started from today's conversation, between the combination of innovation for high growth, the rise of private equity and for growth opportunities, and then also you've got the access to yield through private credit opportunities. When have we ever seen the environment like this, where it's so perfectly primed for yield, growth, and high growth? And so even though it's been a punishing last 2.5 years for the innovation space, that's why I'm optimistic about what comes next. Now, the question is do I know the timing of this? No, right? But from a demographics and from a fundamentals that we're all seeing, because there's a lot of levers that can get pulled in this. And here's the levers. Interest rates, one of the biggest levers that can get pulled in the actual process. So these are the things that I'll be watching for my signals as far as what comes next. Will there be increase in money supply as far as, whether it be the central governments, buying and starting to stimulate and put money back into the economy, right? Will there be dry powder coming off the sidelines that there has been for the last 2.5 years, or that have been going into the private credit opportunities? And then the last one is, and we're less than 2 weeks away from it, is the US elections, right? It's undeniable that what happens in that election will have a significant influence in what comes next from a business perspective. So for me, these are the 4 levers that I'm watching to understand what moves I need to make. But fundamentally, the strategic direction around innovation, private credit, the non-bank lending area, what's happening in private capital markets, but then also what's happening in succession or business exit area, they are going to be the areas that we're focused on. So that is it for my presentation.